$300 silver and $5,000 gold. That's what I'm expecting to hear from you today, Peter, because you wrote a book called The Great Silver Bull. And I think that's how bullish you have to be on silver to write that book. But hopefully I can also provide some pushback as well, because at a certain point, these price targets might start getting out of hand. We'll talk about that. So I'm looking forward to this conversation. That's the conclusion. After our conversation, for people listening, I am also looking forward to my conversation with Alaska's newest gold producer, that being Contango, or with Rick van Nieuwenhuizen. And I'm also going to have a conversation right after that with a prospect generator by the name of Riverside Resources. So busy and long episode of Real Money Talks this week. So let's start already maybe by talking about those again, price targets here, Peter, because you made the that $300 silver prediction that I'm talking about. I'm not making it up. You made that prediction, what, about 2 years ago now, I think, in your book. So what do you think we're still on that path to 300, or are we going to go back to 20 before we get there?
Well, Antonio, first of all, thanks for having me. It's an
Sure.
honor and a pleasure to be here chatting with you, and I've enjoyed your work in the past, and look forward to chatting. And so, as far as where silver is going, I don't think we're ever going to see 20 again. I really do not. That's like that would be about 33% correction. I shouldn't say never. Some kind of a severe crisis hits. We saw it back in the financial crisis. We saw it. I was just looking at some of those numbers yesterday with gold. Actually, it went from near 1,000 to right around 700 in a span of maybe, I don't know, it was about a month and a half or so it took roughly. And then when you look at what silver did in when COVID hit, I remember very clearly because it went from about $16 just prior to COVID to about $12. And that took a matter of a few weeks, maybe a couple of weeks. But then silver turned around pretty dramatically and rallied really hard from $12 to $30, and that offered a 140% return to investors. So I think that, again, never say never. It's possible that we could see something like a $20 silver. I just think it's improbable. It would take extreme circumstances that are always possible, but I think the bias is to the upside. As far as getting towards my target, we've got to get through 31st, but that's a 10x from there. I really think that this is kind of a new paradigm. If you look at some fantastic work by a colleague of mine, Jordan Roy Byrne, he does fantastic technical analysis. And he called this silver bull market and the eventual breakout in silver as one of the most I guess the most textbook and most dramatic and the most meaningful technical breakouts ultimately when we get it of all time, because we have this cup and handle formation which started with silver at $50 back in 1980. It hasn't exceeded it, but touched it back in 2011 when silver peaked at over $49 in April that year. And then we obviously have traded down and back, and now we're approaching 30. And when you see the formation of that handle on the cup, it is really meaningful for silver to ultimately eventually break past 50. And I think from there, I'm not going to say there's no limit, but the limit is going to be a whole lot higher.
Hmm. But is that, I see these titles. I put it in my titles as well, because when I talk to people, like Andy Sheckman or Peter Schiff or whatever, they're gonna tell me, Andy Sheckman was talking about revaluing gold to 20,000. Peter Schiff was saying $20,000 per ounce of gold wouldn't even surprise him. And I mean, what do I know? But $300 silver and $20,000 gold sounds like a world in collapse. Not something I'd ever want to see happen, to be fair, even though I am leveraged toward gold and silver. I wouldn't want to see it happen because it doesn't sound like a fun world to be in. And so then I wonder, are those serious predictions? Is there a way for us to hit those price targets without really seeing the world in a collapse?
Well, I mean, if we're talking about $20,000 gold, I would agree that it's probably, I think it's likely going to be in pretty dire situation. But I can only speak for how what I expect to see happen, and I've been saying since probably about 15 years actually, that I think ultimately we're going to see a $5,000 price for gold. We're halfway there now. And when I wrote my book, really, I was doing the research and saw that highly accomplished, highly respected analysts that have a proven track record are calling for $10,000 gold. Now, I don't think we're gonna, those are probably not the nicest, the most friendly circumstances either to see gold reach $10,000. But how I got to my target of 300 on silver was I said, okay, I think, a reasonable target in gold is 5,000. I still am convinced we're going to see that. Um, and so I looked at multiple indicators, and I think probably, sort of the simplest one to dial back to and consider is the gold silver ratio.
Mm,
And so I asked myself, well, okay, what's reasonable? And if the gold silver ratio reached actually below 15 back in January of 1980 when silver peaked at 50, gold was about 850. So I said to myself, if you have to make some assumptions, and one of my main assumptions was gold reaching 5,000. And again, as I say, I feel that's reasonable because others who know a lot and have done a lot of research and backed research and say, we're going to see more like 10,000. So if I stick with $5,000 gold, and I'm conservative in terms of, in a mania phase, a peak of some kind, and that's really what I'm talking about, of the gold silver ratio, not even having to reach 15, but let's say half of that, 30. So if you have $5,000 gold and you have 30 on the gold silver ratio, then you're looking at $150 silver. And if you're talking about something like 30 30 or so, then $10,000 gold, let's say, would bring you to $300 silver.
mm.
These are indicators that I think are quite reasonable. There are others. I look at the Dow silver ratio. I look at for example, the U.S. average home price to silver ratio, and all of these different ratios. When I look at where they peaked back in 1980, and I think that this bull market will be, an order of magnitude larger. If I base myself on those prior peaks, which I feel is reasonable because I think we're going to have a much bigger secular bull market this time. Then that's why I keep getting back to this target of $300 silver. And again, I say that this is something that is likely, but likely in a mania phase, because you can imagine this is going to wreak havoc on industry, which increasingly relies on more and more silver in all kinds of applications, electronics, solar. We can talk about all of that. But so that's why it's going
Mm.
to wreak havoc on industry. I don't expect it would be, a long-term kind of thing price-wise, but I do think in a mania phase we can reach $300 silver.
Is there a world in which we reach, you said we first have to go over 30, then we have to reach 50, and then we see what happens after that. But is there a world in which we do reach some of these highs in silver, but gold goes down or gold stays where it is here? Like, do they always have to go in tandem in the world that you foresee here?
Um, you know, the I'm going to say no, they don't have to. They're likely to, just based on history. The analogs we have, the best analog we have really is the 1970s when, gold was detached from the dollar, or the dollar was detached from gold, I should put it properly. And and then we saw what happened to both gold and silver. Both had a fantastic run. Gold was up, I believe, from memory, it was about 1,400% in that decade.
Hmm.
Silver was up 3,700%. A lot of that gain in silver came in the end, came towards the latter part of the bull market. So, and we've seen multiple interim bull markets in gold and silver, and in silver alone since then. When we've seen it in both metals, silver has outperformed, I think almost without exception, each and every time it has outperformed gold. What I will say that could be different this time is that we're likely to see a peak in both metals. in some kind of a mania phase and in some kind of a crisis. I would expect correction, obviously, as things kind of the dust settles and things play out. What I would say is that given silver's in growing importance in industry, I could see a situation where you may ultimately have a higher floor, let's say on a percentage basis for silver in the aftermath of that, just because silver is becoming so important to industry and becoming really indispensable.
Mm.
So a mania phase that would follow gold. After that, I could see it correcting, perhaps not correcting quite as much because required in so many applications. There are new patents being filed like almost on a weekly basis for new silver applications.
Yeah, well, the majority of its use is still as a monetary metal. So I tend to agree with you. Thinking about, is it always going to move in tandem with gold? It would make more sense to me. Again, what do I know? But it would make more sense to me if it did. What about timelines, though? I mean, on a long enough timeline, anything's possible. But on a long enough timeline, we're all dead.
That's great.
What's the timeline here?
So, I mean, I think that we're going to ultimately see some kind of a peak come within something like 5 to 7 years. These things always take longer than we expect. Um, I don't want to use the word hope because, like we said earlier, we may not be too happy with the conditions at that point in time. But some people will say, well, things are going to be, if things are that bad and gold is at 5,000 or 10,000 and silver's at 300, you don't want to live in that kind of world. But I find that kind of silly, really, and dismissive. And to me, the bottom line is, odds are you're not escaping that world. So you might as well have the protection that precious metals will afford you. And so you may as well own those metals and be able to benefit. Just be smart about it and look for the signposts as we ultimately reach that peak. And that is actually something that I take the time to write about in the book and talk about what those signposts might be when you eventually reach a peak, because you're going to want to take profits and you're going to want to look for other assets that will hold value but are relatively underpriced at that point in time. So, it's hard to say what exactly that will be and when that will be, but this is, I'd say, pretty much unquestionably a massive bull market for precious metals, and there's still time for people to take positions.
Well, but again, what's kind of the scope of that? I'm not asking you like, Peter, tell me what month of what year, what day are we hitting that price target?
Right.
Otherwise, your analysis is not worth it. What I'm asking is more like what are we talking about? What's this bull market going to be? What's the size of this bull market going to be in time? Like, are we talking a 5-year thing? Is it a 20-year thing?
Right. I mean, I think sub 10 years, I think, is likely. And
Hmm.
I would say anywhere between 5 and 10 probably is where we're more than likely to see the peak.
Hmm.
I would separate for anyone listening. I personally would separate uh, more like basic commodities from precious metals. I think ultimately they're going to act different, and I think they have potentially an even longer secular bull market. Um, and that's a whole other ball of wax. But I think for the precious metals themselves, we're going to see a peak come sooner, and we're going to see that all play out earlier.
Okay. What do you say? Where I'm asking that is because I've been looking at the silver chart. That's as far as my analysis goes. But what do you say to people who saw silver go to $50 in 2011 and hoped it quickly double from there, or at least by 2024, which next year or like in 2 years is going to be 15 years, but it actually lost almost 70% over a 5-year period, and it's still over 15 years not there. Is there something in place today to prevent that kind of a move?
I mean, I think that one of the big perhaps factors is the growth in industrial use. Really, that just makes silver indispensable. We should talk a little bit about what's happened with the silver price and kind of why it's behaved the way it has over the last few years. But just to back up for a second, silver's really, if you look at the raw numbers, just to make things simple and kind of from a high level, silver's a billion ounce market every year. So billion ounces comes from mining and from recycling. Roughly 80 to 85% comes from mining, and roughly 15 to 20% comes from recycling.
Hmm.
However, the other side of that is the demand, and demand is 1.2 billion ounces a year. So we're now in a structural deficit of about 20% of supply, which is really substantial. And if you look at the last 4 years, if you go by the expected deficit this year, based on numbers from the Silver Institute, if you accumulate and you add up these deficits for the last, say, 4 years total, we're at over 700 million ounces of silver. So we're at about 70% in the last 4 years of an entire year's mined and recycled supply.
Hmm.
So, things are getting tight. There's no question about it. And so, it's funny because towards February, March of this year, I had been personally asking myself, and I've been getting more and more questions from subscribers about why is the silver price looking like it's capped almost. And I had that sense as well, that what's going on if we have these deficits, we have basically, by the way, if you look at mined and recycling supply for the last 10 years, it's been flat around at right around a billion ounces. And yet we've seen this growth in demand over that time, that's been just tremendous. A lot of that is explained by electronics and especially by solar panels, which has just been off the charts in terms of production growth.
Hmm.
So to go back to that question of why has the silver price not risen more if the market is so tight? Well, prior to, say, 2020 or so, a lot of there were surpluses. They were small, but they were ongoing for probably a decade or more. Not every single year, but for many years. So these surpluses of silver had to go somewhere. People would buy it, for investment purposes, just store it themselves or whatever. Some of it goes to silver ware, some of it goes to silver jewelry. A lot of it, I would say the bulk of it, was going to futures markets where they just stockpile the silver, and then they use it for different purposes to, let's say, back futures contracts, for example. And a lot of it also has gone to silver ETFs. So not all, but most, hopefully, most silver ETFs are backed by physical silver. Some are better than others. There's no question about it. You have to read the fine print in their prospectuses. That being said, a lot of this surplus silver was ending up on the futures markets, was ending up in silver ETFs. Well, if you look at I'm going to say the four biggest places to look are the three large silver futures markets, which is the COMEX, the LBMA, and then the Shanghai futures exchanges. And then the fourth one is the silver ETFs. If you look at the inventories in these four places, they have been falling quite dramatically since some peaked in early 2021 and some peaked mid 2021. But as from 2021 to today, on average, you're down by 40 to 50% overall. Some of those individual markets are down as much as 70% in terms of silver inventories. So it really is looking like it's becoming quite crucial. So if you put yourself in the place of, let's say, a large silver consumer, let's say a solar panel manufacturer, you've got to go out and buy physical silver. You're using silver paste, but let's just talk about actual silver for now. And you have, until perhaps not much longer, you have this above ground supply. I call these secondary supplies, but you have this above ground supply, accumulated, stored silver that you can just go to and draw down on. You can just go and buy your silver. This does not need to be produced by mining or, obtained through recycling. This is just sitting there as stockpiles. So they can go and draw down these piles, and they've been doing that since 2021. Well, at some point, the stockpiles get small enough or I think unlikely, but they could get to zero. Let's say in an extreme case, and you've got someone who's holding a long futures contract and goes to that exchange and says, I want delivery, because they're entitled to take delivery on their futures contract. That's not what those markets are meant for, but I believe they've been used that way in the last few years. Or they own a lot of specific silver ETF and they go to the issuer and they say, I want to take delivery. I have X number of units. This represents so many ounces. I want to take delivery. And I believe they've been doing that as well to some extent. So this can only go on for so long. And based on my estimates, we've got probably somewhere around maybe 12, at most maybe 18 months where these secondary supplies get drawn down completely or almost completely. And that's when the rubber hits the road. And, there has to be a reckoning, and the silver price has to reflect that. So I absolutely actually think that when we saw silver bottom at 22 back in February and have this strong run to 32 by early May, so that was a 45% gain in a matter of a couple of months. I think that the market saw what was happening. They saw that these inventories had been drawn down pretty dramatically over the last few years. And they were saying, okay, well, this is only going to go on for so long. The silver price has to reflect the tightness of supply. So again, I think that helps to explain why the silver price has remained high, but relatively capped, so to speak. Once that cap comes off, that's why I think we're heading to 35, 40, eventually 50, and then, it's no man's land from there.
Right. So I get that point. What I was really wondering about is there's a cap to the upside, but is there protection to the downside? Trying to figure out what the risk reward is. And at the beginning, you told me you don't think it's going to go back to 20.
Right.
Basically, the question is why? What's capping the downside?
What's capping the downside, I believe, is this industrial demand, which has grown. Just as little as maybe 5 years ago, you were looking at about 50% of silver going to industrial demand. You're now at 60%. So I think that's significant because industrial demand is quite steady. A lot of it is electronics. A whole lot of it is solar. And, of course, you can argue, and that's what people do argue. They say about silver and silver demand. They say, if we hit recession, when we hit recession, things will slow down, industrial demand will suffer. And I'm saying I'm open to that. Yes, I would not be surprised to see that happen. I would actually be more surprised to see actual consumption go down significantly rather than price go down significantly. A drop in the silver price, if we hit recession, would not surprise me too much, but actual consumption dropping significantly would surprise me. And I say that because so much of silver now goes to things like solar panel manufacturing. And a lot of this application is government mandate application because of this entire move towards, this green transition and renewable energy and so on. So I believe that ongoing solar panel manufacturing will stay up. Here's an interesting side note. You could actually have solar panel production level off, or even perhaps fall slightly. And you could still see the consumption of silver from that industry stay flat or rise. And the reason for that is that we're moving into new technologies for solar panels. Until maybe last year or so, there was the most, I guess, used technology had a certain amount of consumption of silver. And we saw the amount of silver going to each solar panel was kind of dropping, and it's been flatlining the last couple of years. Well, there are two new technologies. The next technology, which has actually gone from about 10% of manufacturing capacity, is now something like 60% this year of all new solar panels are going to have this new technology called TOPCon. Uses 50% more silver per panel. The technology to follow on that, called HJT, is using 150% more silver. So even if you get a flat line in in solar panel manufacturing, this move to technology that requires more silver per panel basically guarantees the same or more silver consumption from that entire industry. So really, it's that to me is essentially a bit of a soft floor in silver consumption and therefore the silver price. So where reasonably could I see the silver price go? I think a bottom could be somewhere around maybe 26 technically. If you look at what so how the silver price has behaved, I think that's a reasonable floor. If you see silver hit 26, I think that's a time to be adding to your position if you feel that you don't own enough.
If you don't think a recession would bring a dent into silver demand, what then would? What do you think the main risks for silver are today?
I think some kind of a crisis, some kind of a financial crisis of some kind, of black swan. Again, by definition, as we all know, not definable, but some kind of a serious enough crisis, financial global crisis. It could be a banking crisis, sovereign debt crisis. Hopefully, not some kind of war or something along those lines, but that's what I would think, would be significant enough. Look at COVID. That was, certainly, I guess depends who you ask. Could be defined as a black swan, but let's not go there. But certainly big enough, right? Big enough to make a dent, at least a temporary one. And it wasn't that big. What I find interesting is if you look at what happened during the financial crisis, I remember that the circumstances around that well enough that when that hit, governments were looking to stimulate. And one of the absolute go-tos when governments stimulate is infrastructure. And as we moved, towards this socially acceptable green transition, et cetera, one of the most acceptable areas to stimulate within infrastructure is anything green, and renewable energy is a big one. Solar, by 2030, or perhaps even before that, I can't remember exactly the numbers, but the International Energy Agency put something out, which I think it was 2030. Solar would become the single largest source of energy from that point forward. It would replace coal for the first time ever because more and more money is being put into solar. And China is actually, in many cases, willing to take a loss on some of their solar. It's heavily subsidized. I believe they're willing to take a loss on a lot of their solar panel manufacturing to absolutely dominate the industry. In fact, solar panel prices are falling, which makes using solar to generate electricity cheaper and cheaper. I'm not going to get into, why the prices are falling. As I say, I believe it is, these heavy subsidies, but there are, economies of scale and so on. But that allows them to dominate that industry, and we certainly see solar becoming more and more of a widespread source of energy. I think that when we hit recession and stimulus programs are likely to come back, that solar will benefit from in a big way from that once again.
Mm. Would you have expected this to have happened sooner? I mean, for us to go higher sooner. I mean, gold has surpassed its previous nominal highs, but when you wrote that book a couple of years ago now, did you expect, looking back at it in 2024, to be at 40 or 50 or possibly higher silver?
I did. And I think that's probably one of the characteristics of, people like me, a pundit slash analyst. We always expect these things to come faster. We always think these feel like these things are imminent, I guess. But they're not. And all kinds of things happen in the meantime. But that doesn't mean that they aren't unlikely. And I think they're not only unlikely, I think that they're almost certain. I'll just give you a couple of examples. People complain about how gold took so long to get to 2,500. Well, I remember quite clearly that back in 2001, so we're talking about 23 years ago, um, gold was $250. That's about where it bottomed. If you'd asked anyone then, even the pundits, where gold was going, they would have, guys like Jim Rickards, Doug Casey, on and on, said, yeah, we're going to see 2,000, 3,000, 5,000, 10,000. I'm sure there were forecasts like that back then. It's hard to to look that far ahead and to have a fair bit of confidence, making predictions of that sort. Well, we are already today, unarguably, at 10 times where we were back in 2001. That's quite a decent bull market. Yes, it took 23 years, but that's pretty decent leverage. If you look at gold and silver over the last 20 years, when their bull markets started, they've actually outperformed the S&P and the Dow significantly. The S&P and the Dow, and in fact, this is what I find interesting, and that's why people would need to look for different sources of information and not rely on mainstream media so much. Because if you were to ask the average person, the average investor, where do you think the best returns have come from over the last 24 years, back to say 2000 when stocks peaked, and they would almost invariably say, well, yeah, S&P, the Dow, the stock market. Well, that's clearly not true, because the Dow and the S&P are up a little over 200%, despite, if you think about stocks and all of, the media and research and information around stocks, you'd think it's been unquestionably the best place to be. Well, actually, if my numbers are right, just from memory, silver is up over 400% since then, and gold is up somewhere close to, I think, 650% since then. So just easily doing zero trading, buying physical silver and physical gold, or an ETF, which I'm not sure if gold ETFs existed at the time, but silver ones for sure did not until 2006. But let's say you bought physical metals at the time, sat on them until today, you'd have doubled or potentially tripled your money versus owning stocks. So, that goes to show you, you need to look. And I think that we are in a very long secular bull market. Secular bull markets tend to run about 20 to 25 years. Yeah, if, on that basis, you could argue we're getting long in the tooth in this secular bull market from 2001. We're already in 23 years. I think that, and this is not an excuse, honestly, but I think that given the kind of money printing and inflation and all the other circumstances that have gone on since then, playing with interest rates, et cetera, coordinated easing and quantitative easing, et cetera, around the world, I think this is going to be a secular bull market in precious metals for the record books. And that's why I think that it's got, we could easily, if we're 23 years in, I could easily see this going to 30 years, which would bring us to 2030, 2031. That's right in the middle of my target. So I think that there's a lot left in the tank for both metals. People really do, I feel, need some exposure to them for protection.
Why do you think then what I just mentioned, the gold has already surpassed its nominal highs, silver hasn't? What's holding silver back? Is it what you just told me, that it's got a cap on earlier on, or is there a more fundamental reason that's baked into the cake?
I think it's twofold. Yeah, that is being whittled away as these inventories are being drained. And partially it's just the way silver tends to behave. It does nothing for a very long time, but then it comes out of its shell and it explodes higher. And this is very characteristic of silver. We've seen it happen over and over in silver bull markets. We saw it. You can clearly look at what happened to silver in the 1970s analog. Gold easily outperformed it for, let's say, the first 8 years or so. And then in that last couple of years, silver really started to catch up and then ultimately easily outperformed. Like I was saying before, the numbers roughly are about a 1,400% return in gold in the 1970s and a 3,700% return in silver, though that's almost a 2.5 time return over gold. Certainly worth, your patience. So, it's frustrating. It's difficult, but it requires a lot of patience. It's also a very volatile metal, and it's the stocks that go with it. The equities are even obviously more volatile, but highly rewarding for anyone who has the patience to stay with it.
What do you think is going to make, or maybe you should, I'm just thinking, what is it going to make it stop lagging over the short run? So not so much what is it going to make it go up over the long run, which is what we've discussed so far. But what is it going to make it stop lagging over the short run? That is there really a reason, or is it that black swan event? I don't know if I'm making sense here, but I'm just kind of trying
absolutely.
to think through the whole conversation.
Absolutely. So, I mean, here's an interesting perspective. The industrial demand has grown from, let's say, 5 years ago, from 50% to 40%. Sorry, to 60%, meaning that and here's how I quantify, and this is being a little bit generous in a way, but how I quantify the investment side of silver. So, ballpark, it's 50-50, half of it's industrial, half of it's investment. Now that has shifted. Like I say, industrial has become more like 60%. So if you accept that and you say the other 40% is investment, and I lump jewelry and I lump silverware along with investment, actual investment of buying physical coins and bars to make this 40% of demand. Well, if investment demand has gone from 50% to now 40% because that 10% has shifted to industrial, that just means that industrial is taking more. Industrial is more of a steady kind of source of demand. Yes, of course it can and will fluctuate, but because the uses depend on it so much, I believe it's going to provide a rising floor under the silver price, and that it's this investment demand which now has less silver available to satisfy it. Meaning that those flocking to silver for investment purposes, for inflation protection, as a hedge, as safety, all of these safe haven aspects, that means there's less of silver available for that use. So I believe they're going to help drive the silver price up even faster when the time comes. So, some kind of crisis, I think that would, let's say something like a recession be enough? It'll help, for sure. It'll help, because I think in recession and at the end of a cutting cycle, or during or towards the end of a cutting cycle, you're likely to get stimulus once again. Investors are waking up to that and realizing what it does to their purchasing power. And I think that you're going to see silver really start to make some very big moves in that kind of environment. So here's an interesting point. I had seen multiple times a chart put out by a group called Incrementum that looks at how gold behaves in recessions. And sorry, in fact, it's not recessions. That what they looked at was rate hiking and cutting cycles. So rate cycles. The Fed raises rates, leaves them flat for a while, and then they start cutting. So they wanted to see how gold behaves in those cycles, which are quite predictable. So gold actually does really, really well, starts to take off when you reach the peak in the rate hiking cycle. So that actually lines up with, the Fed stopped, if I remember right, the Fed sort of stopped hiking rates towards the late last year. Gold has taken off since then. Silver does something a little bit different. Silver actually waits for the rate cutting cycle to start. And So we can't know when it starts and we can't know when it ends, but we can look at history and see how silver behaved in that cycle. So pretty precisely, actually. So when the Fed starts to cut rates, and then again, as I say, as you look historically, you have this drop in the rates. Let's say in this case, it's from 5.25, and then let's say ultimately they cut to 2. So between 5.25 to 2, when you get that middle point, which is let's say roughly 3.5 or 3.75 or something, that's when silver takes off.
Hmm.
And so I've looked at and charted the last 3 times that the Fed cut rates. And in the middle of that rate cutting cycle is when silver takes off. And silver takes off dramatically. Silver absolutely, unquestionably outperforms gold in those cycles to the tune of the last 3 cycles, silver averaging more than 300% gain when it started to take off in the Fed rate cutting cycle. So that's something that we can look forward to in, I'm going to say probably realistically within the next 18 months or so.
Hmm.
That's a pretty short time frame, because if we're at if we accept that the Fed will start cutting in September, and we figure that it'll take them a year and a half to finish playing out their rate cutting cycle, that could mean somewhere around sort of the middle of next year, silver will absolutely start to take off. And 300% from, I'm not saying that's going to happen this time, but if silver's at 30 today and it's still at 30 when they're halfway through the rate cutting, and you get a double or even less. I mean, I could see in this cycle, in this rate cutting cycle, silver could at the very least finish that cup and handle formation
Hmm.
and have that ultimate bullish breakout above 50 once and for all. So
Hmm.
that could be sometime next year. Would not surprise me.
I can definitely appreciate the bullish view on silver, and I appreciate the way you're explaining it here, Peter. You do write a silver focused newsletter, so inevitably and rightfully so, I'm going to get a comment saying something like, "Yeah, what did you expect?" To get an answer,
Sure.
when you ask a silver newsletter writer about the direction of silver, he's going to say it's going to go up. So, how do you do it? How do you manage your personal opinions with your inherent business biases, if you want to call it that?
Sure. I mean, look, I'll be honest. I'm not a constant bull 24/7. There's no doubt about it. In fact, if you look at if anyone wants to subscribe or whatever and look at my last couple of issues, so I'm talking about uh, this goes on actually maybe a little bit longer, but for sure in the last couple of issues, so early August, mid-August, my last 2 issues, I'm talking about the risk of a near-term correction in silver. So I'm saying that despite silver being at, say, 29, close to 30 or so, I feel that there's a risk, there's a very reasonable risk that we're going to see silver touch 28. It did do that since I said we had that risk. My downside target was as low as 26. And my reasoning was the following. I looked, as we said earlier, we've seen it multiple times through history. Silver follows gold. And so here are 2 really, really important indicators. So I'm not a constant perpetual bull in silver. I am a secular bull in silver, but on the sort of short, very short term and short term, sometimes I can be relatively bearish, which I honestly, at this very point in time, I am still somewhat bearish/cautious. Here are the 2 indicators that I look at. One is the bullish percent index. This is gold miner. We don't have it for silver miners, but we have it for gold miners. So as silver follows gold, I use that as an indicator. It's not
Hmm.
perfect, but it's high. It's very high, meaning sentiment is quite high, meaning that so this index tells you the percentage of gold miners that are in a bullish formation in terms of their prices and trading pattern. And right now we're at about 78 out of 100, 78%. It's recently was at 90. So in this range, I'm telling readers that be cautious, because I think that no one knows for sure, but I think that there are reasonable odds that we're going to see a correction in gold miners, which would translate into silver miners. When that index drops and falls below 30, then that whole group of stocks is oversold. So ideally what you want is the bullish percent index for gold miners to drop below 30 and then to start ticking upwards. That's when you can typically feel comfortable you've reached a bottom, sentiment has been washed out, and as it starts to improve and moves back up above 30, it's time to start allocating again to that sector and become a little bit more take on some more risk. The other thing that I look at is the commercial hedgers in the futures market. That we can have numbers from for both silver and for gold. Commercial hedgers are what we call the smart money. These are large investment banks. They are large producers of the metals. And when they have, so what they use the futures market for is to protect downside, right? They produce silver, they sell their silver. What they don't want is to get a low price for silver if if they're going to sell it the next month or a few months out. So it's interesting. You can use that, to give you some idea of what they're thinking. And if their net short positions are historically high, that means that they feel that the silver price is relatively high, meaning that their concern is that the silver price will fall. So that's where we are right now in both gold and in silver. So they feel that they need to buy protection against a drop in the silver price. Again, none of these indicators are perfect, but historically, they have worked quite well to tell you that there is heightened risk in the price of the metals and heightened risk in the price of gold miners. So I'm not a perpetual bull. Near term, I'm a little bit bearish right now, and I'm telling subscribers, be cautious. I think there's still some room for correction. Here's one other indicator that I follow closely, a third one. So your listeners and viewers are getting a bonus, is the dollar. The dollar has sold off pretty dramatically in the last few months. Where now US dollar index is a little over 100. It fell, just from memory, maybe 4 or 5% in the last few months. That is huge for the US dollar. And technically, it is quite oversold, meaning that everyone's sort of, bought the rumor. They're going to get ready to sell the news when the Fed actually cuts rates. Powell at Jackson Hole basically, made it obvious now that they're going to cut. And so people are selling off the dollar, which makes sense because lower rates means a less valuable dollar. It pays less. But as I say, these are the markets, and there's buying the rumor and selling the news. So I believe the dollar has gotten oversold, and I think it's due for a bounce. And that could, bring it up, not hugely, but, bring it up perhaps to its 50-day moving average or something. We could see, some several basis point gain in the dollar. And I would think in the short term, that will hurt gold and silver prices and the miners by extension. And so that's why for the next sort of 3-4 weeks, I remain cautious. And I think that, that's how I'm playing it and how I'm telling my subscribers to play it.
What percentage are you exposed to physical silver versus silver stocks, and does that change with your macro take on silver and where it's going over the short run?
Yeah, I mean, exposure on physical versus equities, for example, is probably somewhere around 15%. I think that it's you want some. I think it's always important. I'm a silver bull, obviously, but I have exposure to gold and to commodities in general. I like uranium. I like oil. I like you name it, natural gas, fertilizers, all of that. But obviously, being a silver bull, I have a fair bit of concentration there. So it's about 15% in physical. The rest of my exposure to the silver space is through the equities, and it's across the board. It's everything from the large royalty companies, which I really like. It's the large silver producers, and then from there you have the developers and then the juniors. And, because I follow this space very closely, from what I know, this is the only silver investment newsletter that there is out there. So, lots of people follow silver. It's not a huge market, but there aren't that many of us. So I follow it closely. I'm comfortable with it. So I think that, overall my exposure is probably way higher than the average. People need to feel comfortable. And that's something that I write about in the book. You have to know yourself as an investor. You have to understand this market. I do my best in the book to explain silver's volatility, that it's a small market. It can move quickly, but that volatility can be your advantage and that you want and need to take advantage of it, to your benefit. So again, know yourself, decide how much overall you want exposure to silver in your overall sort of liquid portfolio. And then from there, depending on your risk tolerance, you're going to want to start with some physical, and then you're going to want to add exposure at sort of the lower risk end of the spectrum, and that is the large royalty companies and large producers. And then from there to the higher risk end of the spectrum, which works towards the explorers.
Hmm. What percentage of your net worth would you say is overall reliant on the silver thesis, as in physical silver, but also your silver stocks combined?
So if I would say it's probably somewhere around 20%, 20 to
Hmm.
25%, as this bull, and I'm fully aware of the fact that I think that, it's going to take on a larger and larger percent overall. And I'm ready to let that run because I think that it's going to run a long way. What I will do is I will stay very, I'll watch it very closely. It's like Warren Buffett, saying it's not necessarily the best case to diversify a whole lot. Put your eggs in one basket and watch that basket very closely. And to some extent, I subscribe to that point of view. That's why, I think that precious metals and commodities in general, resources are absolutely the place to be. I think that, we're in what I have been calling an inflation decade, and you want to have exposure to commodities. I believe that the lower risk part of commodities are going to be the precious metals. They will likely do well through all kinds of business cycles. You're going to want that exposure, and you're going to want to maintain that exposure for the extent of the secular bull. And I think that, out to 2030 and maybe a little bit beyond is very realistically how far this thing can go.
Hmm. What are you typically looking for when you look at a silver stock, and does that also change with the bull market? Because I know in different stages of the bull market, it's different sizes of companies that move more. So at the beginning, we might see, the larger market caps, more liquid names move first, and so on and so forth. So what are you looking for in a company, and how does that evolve as the bull market evolves?
So, yeah, so you're right. The earlier stages are where the large producers tend to do best. And then the middle stages are the developers and growing producers. And then finally, it's the explorers. So the kinds of things that I look for, and your viewers have probably heard this a lot. If they've been following people like me or so on, and following you, that I mean, has become almost, kind of a repeated thing, but management is key. Really, you want to look at people who've had prior successes. You want to see a track record because a lot of these people are serially successful. They will do it over and over. They know they have a formula. In some ways, they will repeat that formula, and you can, if you're patient, more than likely it will pay off. So look at management, look at people, look at their track record, look at who they surround themselves with the accomplishments, the prior accomplishments of their management team. And then so first is people, and then from there is the actual asset. And then I'm going to say, you obviously want a quality asset. Silver is a strange beast. It's hard to find high grade silver. A little sort of thing to point out maybe for your viewers is that a very quirky part of the silver market is that there are not many primary silver miners. A lot of, as much as 70 to 75% of mined silver does not come from silver mines. It comes from gold or copper or lead zinc mines. So only about 25% of mined silver actually comes from what we would call silver mines. So a lot of, we depend on the mining of these other metals and in order to get most of our silver. It's really quite odd, but that's how it is. And that has all kinds of implications we can maybe get into another time. But you need to look at the asset. You obviously want higher grade. That is preferable. I have a bias towards, so be careful when you look at someone who says, we're a silver miner, look at the asset, look at how much of the actual deposit is silver, or how much of the actual revenue comes from silver. Um, I like to see as at least 40% of revenues coming from silver. I'm being quite generous, and if I were not, then I wouldn't have a newsletter because there'd be so few silver miners or mining companies to include. And if you're a silver explorer and they have a deposit, then I look for at least 40% silver content. I have a bias towards, if there are other metals in there, towards gold, because the idea in many cases is that, you're using this as a hedge and as a safe haven. So I'm certainly biased towards the other metals if they're gold. And so if some of the other metals are copper, lead, or zinc, then I'm a little bit less favorable. But, in other words, understand what you're getting when you're buying this company, this stock, in terms of what the different metals are. Many companies, I have a saying that is that they masquerade as silver miners when they're not. You need to know what they actually have in the ground. And as you go through the cycle, and then you move towards the developers, for example, you're going to want to look, that's where you're going to want to look at how the company is set up. Do they already have an asset that is producing cash flow, and they are still aggressively growing another asset? That's, I'm going to say, possibly ideal, because they're not reliant on going back to the markets all the time to issue shares to fund to get cash that they need to. They could be in sort of this downward or towards the bottom of the Lassonde curve, and that gets expensive and it gets boring, and investors become disenchanted. So if a company is a producer but they have a big development project, I'm going to say that's ideal in terms of developers, because again, they don't have to keep going back to market to raise money to move their development project forward. If you're looking at juniors, again, management is key. Again, grade is key, and jurisdiction becomes more important than ever, because we hear all kinds of talk about risks in certain jurisdictions. You want jurisdiction with a long history of being favorable to silver and silver mining, or mining in general. And I think that as this bull progresses, we're going to have with little choice, we have to become more, I think, more and more open to certain jurisdictions, which maybe we were less favorable to before, just because we're tapping out silver. Silver is found in not all that many places. The most, if you look at a map, let's say you're looking at the Americas, for example, mostly you're just going to look at the west end of the Americas. So you've got Western Canada, you've got Western US, you've got Western Mexico, and then you've got some of Central America, and then you've got some of South America. Most of the silver in the Americas lies in the West, and that's this entire mountain range, basically, that's almost continuous, and that helps explain why you find the silver there. Then you find some silver in Australia. Other than that, you find some in places like Poland, Russia, a little bit in Germany. You find actually some in places like the Balkans, and really not a whole lot else. You don't find much in Africa, for example. In some of these other places you do find it, but in higher concentrations, these are mainly the places where it will show up.
Good. Well, Peter, we're coming up to the hour that you had promised me, or that you said you can endure talking to me and looking at my face, which I can understand, by the way. What am I forgetting to ask you here though at the end? What's important out there for silver that I'm failing to bring up, but you think should be talked about?
I mean, we've really done, I think, a great overview of the situation, the opportunity in the market. I think that really it just needs to be summed up as that silver goes through tremendous bull markets. I think that anyone watching now is still should consider themselves relatively lucky in the sense that we are quite early still, I feel, in this bull market. It has much, much higher to go. And even despite the kinds of gains we've had in the last few years in silver, the equities offer even better leverage. They have moved, but they have not, I feel, even moved the way they normally would, along with the silver price. So relative to silver, I think they're still even more undervalued. The opportunities are fantastic. I feel that anyone and really everyone should have some silver exposure in their portfolios. Do not let its volatility scare you away. Make it your friend, but know yourself as an investor. And with that, determine how much exposure to silver and to which ends of the silver risk spectrum really you want to have that exposure. And that, as I said earlier, after the physical, which should be the first part, then we're talking about sort of the miners and the lower risk producers and royalties all the way down to the higher risk explorers. So have exposure to silver, decide how you're most comfortable with it.
That's an yeah, I can see that, but it's not an approach I'm using. But it is an interesting approach. I used to use that approach. Didn't quite work out for me. Happy it's working out for you. Maybe we should talk about that next time. We'll talk about how and why you've constructed your portfolio that way and what results that's generated. And that's something I wanted to ask you about, but I see that we're already over the hour. I know that you have to go. So thank you for sitting down with me, Peter. I'll let you drop off now. I'll put your stuff on the screen for people who want to know more. They can go and find you on Twitter at Peter Krauth. I'll be moving to my favorite part of the Real Money Talks episodes, though, and that's of course the disclaimer. Right after which, I will be jumping over to the CEO barbecue, of course. But disclaimer first. Not only a disclaimer, it's a warning. It's on your screen. You're obligated to read it, but you're also advised to do so. And this is the first and only advice that you're going to receive in this video is to read that disclaimer. That's it, because this is not just some disclaimer. This is an actual warning. If you read and understand it and follow it, it will help you lose less money. At least that's kind of the hope here, I suppose, unfortunately. But by the way, that's the norm. That's why I'm kidding about it. But this is the norm and should be the expectation in the sector. It's a tough sector. Chances for success are very low. So keep that in mind. But also understand that in this episode specifically, none of the companies that you see have paid to be here. Peter didn't pay. The companies didn't pay. Nobody's paying me. Well, there's a little bit of ad revenue, I suppose, on it from YouTube, hopefully. But even though these are not paid for interviews, you should still understand that the companies that come on here are likely seeing their participation in the program as a chance to do some marketing. So start there. Start by understanding that really all company communication out there, it could be the website, it could be the presentation, it could be their social media account, the news releases. That's all marketing. You go to a conference, obviously marketing. Interviews, obviously marketing. Your favorite influencer picks up a stock, tells you it's the next best thing. Definitely marketing. Okay. So understand that, and also understand that although I don't make buy or sell recommendations, because there is a clear conflict of interest, many out there will do that, and you should be aware of that inherent bias. That bias is not always going to be clearly disclosed with everyone out there. So it is safer for you anytime you're watching any type of company-specific content. Just approach it with a dose of skepticism. Assume that the person who's telling you about it is biased toward it, is being paid, or something along those lines. Just treat it as marketing. Unfortunately, none of us are magicians, to my knowledge at least. The guests on here are not sidekicks, and even some of the CEOs are normal people. So we don't possess any superior knowledge about what's going to go up, what's going to go down, what's going to go backwards or in circles. We don't know that. Nobody knows that. So there's going to be no guarantees here besides one, and that is that there's going to be forward-looking statements in these conversations that you're going to listen to. Those are conversations that are general and impersonal in nature, and they're going to be containing hopes for the future. And those are events that may or may not take place depending on many different factors, both within and outside of the company's control, including the literal weather. That's how much of a forward-looking statement they're going to be in this conversation. Be aware of that. Be aware of the inherent risk to investing and the increased risk of investing in non-revenue generating companies, and especially companies that are operating in the harsh reality of the mining and the mineral exploration industry. And please talk to someone who's proven to know what they're doing, and someone who knows what they're talking about, like, for example, a professional investment advisor, as well as do more research before taking any decisions by visiting setterplus.ca, where you're going to find the company's official filings. If you don't do that, you're highly likely to lose your money. Again, disclaimers on the screen. If you don't enjoy losing money, pause it, rate them. With all that said, though, I'll be kicking off the CEO interviews portion of today's Real Money Talks episode by traveling to Alaska once again, which is Alaska, surprisingly a place that I've spent quite a lot of time in recently. Last time I was looking at a nickel deposit. This time I'm looking at Alaska's next gold mines. Luckily, I'm not doing any of that alone, as I am joined by Rick van Nieuwenhuizen, which is the right pronunciation of his name for every American listening. He's the CEO of Contango Ore. And for once, all the numbers I'll go through here are in US dollars as opposed to Arctic pesos or Canadian dollars, whatever you like calling them, because Contango is actually a New York Stock Exchange listed company trading under the ticker symbol CTGO. There's an average daily volume of about 86,000 shares and a little over 12 million shares outstanding, combined with a $255 million market cap, means that Contango is a $21 stock at the time of recording of this video. Options and warrants are about 1 million units combined, leaving us at around 13 million fully diluted shares. Insiders here own 18% of the company. That's 1/8, while 43% is owned by institutions, leaving just a little under 40% in the hands of retail investors as well. The last financial statement, or at least the official financial statements that have been filed, was dated March 31st, and that shows me $9 million in current assets, which at the time, most of which was in cash, and that's over $7.5 million in cash with a $1.2 million prepaid expense in there as well. Current liabilities, again, at the time, sat at around $32.7 million, about 65% of which was the current portion of the debt. Non-current liabilities sat at around $67.4 million, over half of which is also recognized as debt. Worth noting, though, that there is a significant part of the liabilities, so there's about a $20 million convertible debt that is signed with Queens Road Capital. It's also worth noting that since this 10Q was published, the company has also announced the closing of its second quarter of this year, as well as they've poured the first gold from one of their projects. They've also delivered their first gold, and they've also done an acquisition. There's a drill program that's been started, and there was a $15 million underwritten financing this summer. So the state of their financials is likely to be different by the time you're watching this. And rounded up, the presentation says there's $24 million in cash and a total gross debt of about $80 million. In terms of corporate expenses, though, the same financial statement from March shows me that when stock-based compensation is excluded, Contango spent on average about $600,000 per month over the last reported 3 months on what I would call administrative expenses, where about 40% of it went into salaries, benefits, and director fees. About 20% went into professional fees, 18% on insurance, and a few various smaller costs like marketing, which, by the way, only came up at about 3% of the G&A that went into marketing and investor relations. As always, though, please understand that this financial statement is nothing more than a snapshot in time. In this case, it was specifically at the end of March of this year, and it simply shows you what the finances look like on that one exact specific date. Nothing more. Finances, though, are a fluid thing, as you would know. I could also be making mistakes in my reading of them. So by the time you're watching this, please head over to the company's website, as well as the SEC website. I typically say setterplus.ca. I'm so used to saying that, but this is a US company. So you go to the SEC, look at all the numbers yourself, make sure you're getting the full picture. That's your responsibility. Now, for Contango, the part of that full picture Actually, the full picture is not that complicated to understand. It's all about Alaska. It's all about actually producing gold, which is again what they're doing right now. More specifically, excuse me, they have 3 projects as of recently. They used to be 2 after the acquisition. It's 3 projects, and they are in what the company defines to be the Alaskan Golden Triangle. And I'll maybe start with the Manh Choh mine, which this is where the company first they poured their first gold this year, and that's a currently producing mine as it is right now, and ore is here being processed at the Fort Knox mill. So this is a DSO operation. Fort Knox mill is located close to Fairbanks, where, as far as I understand it, is also where the company's headquarters are. And the mill is, of course, operated by Kinross, with production during the current quarter, so Q3 of 2024, expected to start bringing in free cash flow, which annualized would come up to over $50 million worth of positive free cash flow for this one operation. What's most notable about this mine is that this is one of the highest grade open pit gold mines in the world, with average grades expected at around 8 grams per ton, and a forecasted all-in sustaining cost of $1,116 per ounce. At $1,900 gold, Contango's share of the production will bring in about $130 million of annual revenue, and again, over $50 million of free cash flow. But at the current gold prices, you're not supposed to use spot price calculations to run a business. But luckily, I'm just talking head on the internet, so I can paint whatever picture I feel like talking about. So if gold stayed here where it is right now, at 2,500, that free cash flow from Contango's 30% share of production jumps to over $93 million. Again, not representative at all, merely illustrative. Also worth noting why it's not representative in this situation is because in August of last year, Contango went into a price hedging agreement to sell a total of almost 125,000 ounces of gold at a fixed weighted average of, I want to call it $2,000. What's $2,025 per ounce, starting in July of this year and extending throughout the entirety of 2026. I'm also just casually mentioning 30% without further explanation. So before I forget, 70% of the Manh Choh mine is owned by Kinross, and Kinross is also the operator of the mine. Contango, of course, believes that there is more gold around that mine that what is currently defined. So they're spending about $5 million on exploration on the land package around it. With in 2024, they're spending that $5 million, with at least 5 early stage exploration targets having been defined on the same Tintina gold belt. Talking about exploration, that's not the only focus here. Well, actually, this is not the main focus for the company when it comes down to exploration. This is, again, the producing asset, but their newly acquired Johnson Tract and their other Lucky Shot vein project is where the focus of exploration is. Over at Lucky Shot, again, same region as Manh Choh, but to the southwest from the mine is where this historically producing asset is that the company owns. There was about 250,000 ounces of gold that were mined at an average grade of 40, so that's 40 grams per ton, so extremely high grade. Contango's technical report, though, shows over 100,000 ounces of gold at an over 15 grams, so 15.6 grams per ton. So obviously lower than historic average, but still significantly higher than world averages. And more importantly, there's an over 1.6 kilometer open strike length that is open both along strike and at depth. So both infill and expansion drilling is needed, with a 3,000 meter program planned for this year to test the depth of the system, as well as a 12,000 meter infill program within 15 to 20 meter spacing is planned, with the aim, of course, of growing the resource so that the company can come out potentially with a new resource. And they believe that there's going to be about 400 to 500,000 ounces of gold in that new resource. So hopefully we'll get an update on that later on in the conversation. And then over at Johnson Tract, again, that's a new company. No, that's not a new company. That's the company's new project is what I mean, which they got from the acquisition of High Gold. Johnson Tract it's a fairly thick ore body. So whereas with Lucky Shot, we're talking about high grade, narrow veins typically. This is a thick ore body, about 40 meters in width on average, and housing about 1 million ounces of gold at an average grade of 9.4 grams per ton of gold equivalent. Contango, of course, didn't buy this simply for the 1 million ounce deposit that's already sitting there. They bought it because they think there's a lot more exploration upside. And there really is a whole lot that I can say about the Johnson Tract deposit, but I feel like at this point I've been talking for long enough, and I'll point you to the company's presentation, which does a very thorough job at explaining what's exactly going on with the exploration plan, the potential production plan, the property geology and all the things that you have to know. So do go and read that presentation as well as the technical documents that are publicly available. And all in all, I suppose an important question here is why are they even doing this that way, or why did they buy this deposit in the first place? And that is because of the vision that Rick here appears to have for the company over the long run. And the entire strategy for Contango is built around what is acronymed, I suppose, by DSO, which stands for direct shipping ore, where essentially the company only has to build the mine, not build the mill. There's plenty of mills in the region, and the ore gets processed at one of those mills in Alaska, or maybe even across the border, or something that we can talk about. So they produce the ore, it gets directly shipped to someone who processes it. So that sounds like a solid and potentially a cheaper long-term strategy here, Rick. But I think I already asked you this when we first met in Florida earlier this year, but I'll have to hit you with the same question here again as a first timer on the CEO barbecue. So talk to me. Who are you and why should I trust you with my money?
Tony, good to see you again. Well, I'm a geologist by background. I was born in Belgium, hence the long Flemish name, but grew up in Alaska. And I've worked all over the world as a geologist. About 30 years ago, I decided to stop working for large mining companies and pursue my entrepreneurial spirit to form my own company, which was the first company we started was called Nova Gold. We made a massive discovery here in Alaska called the Donlin Project. We joint ventured that with Barrick. And good lessons in that. Obviously, it's one of the larger and highest grade undeveloped gold projects in the world, which is all good. But I left the company in 2011 as the CEO. I stayed on the board for till 2017, and that project is still in the permitting process. So when we thought about Contango, we didn't really want to do the same thing, and by that I mean spend a long time permitting something. And in today's world, it takes about 15 years on average, 10 to 15 years to permit a mining operation once you have a feasibility study done. And that's just the reality of the situation. That's not, it may be a little bit shorter in Canada, but we're in the US, and so that's what you have to look forward to. So we didn't want to do that again with Contango, and so we took a different path and formed a joint venture with Kinross, who had a mine and a processing facility already permitted, been operating for 30 years. So that kind of short-circuited the whole permitting process because we had a very simple open pit mine to permit. Not a tailings facility, not a big power plant, and not having to raise the capital for all that as well. So for those two reasons, we've developed this, what we call the DSO model, the direct shipping ore model. And it really does simplify the permitting of the project. We got Manh Choh permitted in 1 year because we're simply permitting a mine, and then it has to also go with the characteristics of the mine itself. Manh Choh is on top of a hill, so we made the discovery. It's on top of a hill, so we don't have a lot of water to deal with. We're not in wetlands. We're on top of a hill, so we don't have a lot of wetlands. And those are all things that the more wetlands you have and the more water you have, the more complicated the permitting process will become. So as it dealt with just permitting the mine, which is basically just an open pit quarry, we got that done in a year. And so we're now mining and direct shipping ore, direct truck transport the ore up to the Fort Knox mill, which again is already there and already permitted. So we've saved ourselves a huge amount of capital and saved ourselves, 5-10 years of permitting at least. So we're now applying that model to other properties. You mentioned Lucky Shot and Johnson Tract. They both fit the model in terms of their characteristics. Being high grade, you have to have the grade to be able to transport the ore. You have to have a relatively be located relatively close to existing infrastructure, so you don't have to permit that. And that, of course, is the big problem with Donlin. It's in the middle of nowhere, so you have a lot of infrastructure that you have to permit and build. And then the last thing is the characteristic of being a simple mine itself. to permit. And again, Lucky Shot and Johnson Tract were both above the water table with minimal wetlands. And I think the last thing I'll mention on what constitutes a relatively simple project, nothing's ever simple, but relatively simple, is the land you're working on. We just don't work on federally owned land. We work on private lands. In the case of Manh Choh, it's the Tetlin tribal lands that they own outright, surface and subsurface rights. At Johnson Tract, similarly, it's Alaska Native Corporation, Cook Inlet Regional Link, who owns the rights there. And then our Lucky Shot mine, we actually own the rights, so the leaseholder, our underlying leaseholder owns the rights, their patented mining claims. So the land ownership also is an important ingredient in looking at, that we look at for developing a project. So probably a long answer, but I guess bottom line is we've demonstrated the model works with Manh Choh. We're producing gold. We're selling it. We just had sales of over $32 million, and we've got 2 more batches to run this year. So we'll keep adding to the treasury.
There's specifics that I want to ask about that, and I will later on. And I also want to talk about the 2 projects later on as well. Just quickly, so we can go through basically the basics here. There's about an 18% insider ownership. How much of that is you personally? What do you think your average cost of capital is?
So I own about a little over 6% of the company, maybe close to 7. And my average cost is probably about $15.
Okay. Well, that's okay. That's post. Yeah, makes sense. Okay, good. Good. Are there any other incentives for you in there? Like, do you personally or any family members own royalties on the projects, or is there a service company that you own that currently services this one, or any other way of incentivizing yourself?
No, the royalties are owned by the Tetlin tribe on the Manh Choh project, and then there's an underlying royalty to our former joint venture partner, Royal Gold. But we rearranged changed the chairs on the deck a bit with bringing in Kinross as the majority owner. So we allowed Kinross to buy Royal Gold's 40% interest in the project. We obviously had a right of first refusal, and then we sold an additional 30, which gave Kinross the 70%. And they wanted to be the majority owner, and so that was the arrangement. And I have no royalties nor any family members on any of the other projects as well. That's we don't do business that way.
Well, unfortunately for you, fortunately for the shareholders, which I suppose you're one, so that counts as well. No, good. That gives me an idea of how you do that. And you're right. Unfortunately, I have to keep asking these questions. You'd be surprised actually how much that happens. But there's also no financial company or something that's lending money to Contango, nothing along those lines.
No, I part of my compensation, I choose to take in shares. So rather than receive a salary and bonuses, that sort of thing, I take shares in place of cash. And
fair. Yep. Good for you. Talking about this first prediction at Manh Choh, you did what, close to 9.45 grams. You did average grade, that was 95% recoveries, so outperformed on both fronts and what you typically had guided before. But how come? What happened? And more importantly, I suppose, how realistic do you think it would be for you to keep that up over the next 2 batches this year?
Yeah, so obviously what we're comparing to is the feasibility study. So that's the feasibility level mine plan that we made the decision to put the capital into the project and to bring the mine into production. So the metrics there, that was an average of 8 grams per ton over the mine life. The recoveries were anticipated to be 90% average recoveries, and we were on average going to be planning to do about 250,000 tons per batch. We're batch processing the ore. So the process is we mine at Manh Choh. We have 4 different stockpiles there, sort of high, medium, low, and ultra low grades. As we mine, and we put the ore into different stockpiles, and then you blend it back up to approach the 8-gram average. Again, that's over the mine life. Obviously, when you're mining, you try to process your better grade ores first. And so, that's why we have a 9-gram average grade or 9.4 gram average grade for this first batch. We won't maintain that for the end of the mine project, I'm sure. But it was whenever you come up with a mine plan, you're always trying to maximize revenues early on to, pay the project back. So obviously having, a little better grade than average is a good thing. Having a little better recovery than what was anticipated in the feasibility study is a good thing, because we're basically getting 5% more gold than planned. So that's those are all good things. Yeah, so I mean, I think for a first batch, and we didn't start out right at meeting all of our metrics, because when you're processing, the mill at Fort Knox is a big mill, and so we want to operate it at sort of 9,000 to 10,000 tons a day. But when you're running your first batch through, you're making sure all the different connections that are made to integrate the Manh Choh ore in there are actually working properly. And so, we started out at 2,000 to 3,000 tons, and ramped it up to 4,000 to 5,000, and then 6,000 to 7,000, and then finally at the end of the month, we're running in the 9,000 to 10,000 tons a day. So that was our ramp up. It went pretty smoothly, I'd have to say, as ramp ups go. And now that we've got it dialed in, our expectation is that the next 2 batches that will run in September, October timeframe and November, December timeframe will be a lot closer to the feasibility throughput for the mill of about 9,000 to 10,000 tons a day. So yeah, again, as ramp ups go, I think it went fairly smoothly.
What about AISC, all-in sustaining cost? I understand you probably don't have that yet. There was no mention about it in the news release. I mean, are you guiding something? Is that going to go up? Is that going to go down? Is it on target? Talk to me about that.
Yeah, I think basically we're on target. So 1116 is the feasibility study, all-in sustaining costs. I kind of break our costs down into call it four buckets. Mining, which we're on budget for. So, that component of the AISC is on budget. That's roughly a third of the cost. And these are obviously rough numbers, but roughly a third of the cost is mining. A third of the cost, and then mining includes, I'll include administration in that, because it's everything that happens down at the Manh Choh site is, sort of goes into one bucket, if you will. Then you've got the transportation component. And in rough numbers, that's another 1/3 of the costs. That's on budget and on schedule in terms of delivery of tons that we're planning to move between the Manh Choh mine and the Fort Knox site, the stockpile at Fort Knox. And then the last third is processing, and that's the third that we don't have yet in terms of contribution to the AISC. So we're guiding that we're on plus or minus on budget. Clearly, it was a ramp up first batch, so that AISC is based on running sort of 9,000 to 10,000 tons a day, and obviously we didn't do that for the entire month as we sort of did the typical ramp up thing. But I think going forward, we'll be I think the processing will come in plus or minus on budget, and that's basically what it is. Where we're sensitive to in terms of that AISC, oil price is a big one, because we're transporting the ore, and obviously any mine fleet takes a lot of diesel. We're under where we expected, or what we expected or I guess where we sensitized the price of oil to be, or the price of diesel. We're under that. We had anticipated $100 barrel oil costs, or I guess stress tested to $100 a barrel, and we haven't seen over 80 for the most of the year here. So, but that is an area that we'll watch, and shareholders should watch in terms of if the oil price goes up to 100 or over 100, we'll start to see costs go up, particularly in the transportation of the ore. The other one's always labor. Mines have lots of people. But right now, our labor costs are in line with what was in the feasibility study. So, but those are just, a couple of things where we're sort of sensitive, if you will.
How many people work at Mine Show?
There's, I think, about 250 people
Um,
there, and then that's at the mine site. And then the transportation is that's a third party transporting company called Black Gold Transport. They're based in North Pole, Alaska, just outside of Fairbanks here.
okay.
There's probably another couple hundred drivers doing the daily drive there.
Okay.
And then
That's per
Fort Knox,
shift, or is
what's
that
that?
in total? That's
Oh,
per
that's in
shift.
total. That's in total, yeah.
Oh, okay. Okay. That
And
makes more
Fort
sense.
Knox has about 700 people for the whole operation, but the mill is the only component that we really deal with, and that's probably on the order of 200-ish.
Right. Okay. In that all-in sustaining cost companies are free to calculate it as they please almost. What are you including? You said administration costs. Does that include your G&A and marketing and everything? And does that also include your financing costs that you currently have?
Yeah, so short answer is no. Our ASIC is based on the ASIC for the Peak Gold joint venture. What our portion of those costs are, which does include the toll to Fort Knox. The joint venture pays the Fort Knox a toll for the luxury of using that mill.
Yep.
And then obviously once it's there, they're responsible for disposing of the ore in the tailings facility. So obviously there are costs associated with that. So it does include pretty much everything and everything else. Now our administrative costs and our financing costs are not included in that.
Yeah. Okay. Well, would you say that, by the way, because of what you're saying here, would you say that operational risks are the largest risks here, as in, meeting the grades, recoveries, and so on targets, or is transporting the ore over that, what is it, a 240-mile road, I believe? Is that, would you say that transporting is the main risk, or is operations the main risk?
I don't know. There are obviously different risks. I mean, the transportation, it's on a public highway. It's maintained by the highway is maintained by the state of Alaska. Obviously, there's more operational risk in the wintertime, if you will, than in the summertime, although there's more actual traffic in the summertime than there is in the wintertime. Operational risks, we have the mine site, mining is contracted to Kiewit. They're one of the largest mining contractors in the world. That saved a bunch of capital because we didn't have to buy all the mine fleet. They brought it up, and so it's part of a lease price. And there's always pluses and minuses with these things. When you have a 5-year mine life, it just makes sense to lease the equipment rather than or to hire somebody who has the equipment and have them charge you more of a lease rate than a fleet purchase rate. So. But it's a fairly simple mine. It's you're moving. It's a quarry operation. Mine, I'd say the thing you really want to focus on, and then the operations focuses on, is when you have a high grade deposit of 8 grams per ton. You want to make sure that the ore gets the 8 grams goes to the right pile, and you're not wasting ore material, or the other way around, that you're not contributing waste material into ore piles. So. Grade control's probably the single biggest area of concern, and that we spend a lot of time on. I think there's 4 grade control geologists at Manh Choh. It's a skarn style deposit, so it tends to be roll high grade and potty, which is typical for this type of deposit. So that means you just have to drill a lot of holes and have a good geologic model. So. That's how you mitigate the risk around the mining of the ore itself.
I do have a question about how you're hoping to grow that mine life, or where you're going to find more ounces. So we're going to touch upon that later on. As I find that to be one of the main pushbacks that people came up with on mine. One of the other ones, though, that might be worth talking about first here is that hedging agreement that I'd mentioned at the beginning. 2025 bucks is what you're selling. Part of the go at, not all of it. Are you getting a lot of pushback on that hedging book at all? Like when you're talking to institutions, again, they own almost half of the company. What are they telling you about this hedging book?
Well, I mean, we put the hedges in place when we took out the $70 million line of credit from the banks, ING and Macquarie. Nearly 2 years ago. Obviously, the gold price at that time was, I think, 1750, 1800. So selling gold forward at that time for 2025 average price was the only thing we could do, because you could not raise, I would say it would be very, very difficult, and if it was possible, very, very dilutive to equity shareholders to raise 60-70 million dollars of equity at that time. So the only alternative is debt, and it's a very strong economically robust project. So putting debt was the smart thing to do. Obviously, when you're dealing with the bankers and you're borrowing 60-70 million dollars from the bankers, they want to make sure they get their money back, and hedging is the risk-free way to do that. So in order to get the $60 million of debt and not dilute our equity owners hugely, that meant we had to put the hedges in place. So yeah, rough numbers, 60% of this year's and next year's gold will be hedged at the 2025 gold price. So obviously that means we're only selling 40% into the spot price. On the first batch ore that was processed and the gold that we received from that was sold, we averaged just a little shy of $2,200 with that sort of blended hedge price and spot price. So as the gold price goes up, we participate 40% in that for the next couple of years, and but we've protected the downside, and we've guaranteed that we can pay the banks back the cash that we've borrowed from them over the next 2 years. So yeah, I mean, it's a necessary evil, I guess, is the way I'd put it. The hardest thing for a junior company to do is raise money, and you've got two choices. You can use equity, and when the equity markets are open and in a good mood, that may be the case, that's the best thing to do. But we have not had those kind of markets in the last at least 5 years. So going down the debt path was I think a lot more prudent from an equity owner standpoint.
I don't have many friends, but the few I have, I believe to be wise. And one of my wisest friends told me, if you like the deal, take it and shut up. Which I suppose in your case was you liked the deal, you took it, and it's working out so far. What I'm wondering here, though, is so how do you manage out all that debt? Again, in total, it's about $80 million. So how do you manage the debt while meeting production timelines and production numbers, while also growing, which we're going to talk about, but growing Lucky Shot and Johnson Tract at the same time, without having to go back to the market for an equity financing? Because last time that $15 million, it got some backlash, right? So preferably you don't want to do that shortly here. So how do you manage the debt while having to go back to the market?
Yeah, I mean, the raising the $15 million was, again, something that we wanted to have, a bit more cushion going into the ramp up. Startups don't always go smoothly, so when you're spending money mining and transporting and stockpiling, if your startup doesn't go smoothly and you're delayed for some reason, the bills keep coming in for mining and transporting. And so that was the reason for raising the equity. But you're absolutely right. Market didn't like the equity raise. Markets never liked the equity raises. And so you always have to take a discount, which again goes back to, why did we do the debt? Because it was a lot better deal than the equity at that time. And so and I still maintain that was the smart thing to do, is always protect the downside. We don't make as much money. I might feel bad for a little bit, but we've made money, and we've made money for our equity shareholders. Yeah, and as I mentioned earlier, paying the debt off is the most important thing. We paid, I think we contributed $8.9 million to the debt, so it's 20 million of that is convertible debt. We fully expect that will eventually be converted. So the debt to ING and Macquarie Bank was 60, and now it's just a little over 50. So as we process each batch, a portion of those funds will go to continuing to pay the debt down. So yeah, I think as a business, I think we're in really good shape. Obviously, if the gold price keeps going up, that hedge book will, there'll be lost opportunity on that gold, but we'll make 40% of our gold sales at the spot price, and we'll make more money as the gold price goes up, and if the gold price goes down, we're protected with the hedges. So again, it's just you got to run a business a smart way, and when you're a junior startup, you don't have a lot of options. We're not making cash flow anywhere else. So the important thing is to maintain that balance sheet. We don't want to spend that money too fast. You saw our last quarter, we had $24 million in the bank. We'll see what our cash costs are for the first batch when we report Q3, which will be, I think it's late October, November timeframe. And then between now and then, we'll have another batch in September, October, and then a third batch November, December. So I think at the end of the year, we'll be sitting, with probably $30-40 million in the bank, and I think we'll be in pretty good shape.
So you're not going to have to raise capital this year anymore?
No, not at all. And we're going to manage ourselves. So we're spending the next program at Lucky Shot is drilling, so fairly straightforward. And then next year we'll be at Johnson Tract. Our plan, once we get the permit that we're waiting for here, which we expect to get shortly, what's called the Wetlands 404 permit. That'll allow us then to construct the road between the campsite and airstrip over to the portal site for Johnson Tract, and we'll start permitting the underground access to the Johnson Tract ore body. We'll permit that next year in 2025, and then assuming we get the permits in 2026, we can start mobilizing and start construction. Get that done in 27 and get the drilling wrapped up by 28, and be able to develop a feasibility study level mine plan by the end of 28, 29. So that's the plan for Johnson Tract. So we're going to pace ourselves here a bit. We don't need to, well, one, we don't need to, but nor could you possibly get all that work done in a couple of years. So we want to pace it out with the cash flow that we're getting from Manh Choh. And at this point forward, I really don't see a reason that we'd need to raise more capital on the assumption that we keep producing gold at the Manh Choh site, which I probably have every expectation that we will.
Yeah, with again just delivering on cost and all these things that we've talked about so far as well. I suppose the caveat, but it's an important point that you're making here. So you want to have another operational project before the mine life runs out on this one. That's how you think you're going to manage. Because again, I said that's one of the other pushbacks that I could come up with is, oh, we have a 4.5 year mine life left. So how do you solve that? Essentially, you're doing more exploration around Manh Choh on one of those 5 projects, Jason Tract and Lucky Shot, and you hope to develop Jason Tract before the mine life at Manh Choh is over.
Yeah, we're spending, we have a $4.7 million exploration program going on at Manh Choh. Lots of good targets there. Most mines start up with a feasibility level study, and they never mine to the mine life. You always have exploration success. I mean, it would be unusual not to have that. So I do fully expect that we'll find more gold around the Manh Choh site. We've got good targets, and we're spending some dollars. That's part of the joint venture budget this year. But beyond Manh Choh, Lucky Shot we would envision Lucky Shot as our next mine to go into production. It's fully permitted, so You put rocks in a box and get send them up to a mill. We're working on a couple of different ideas there, which mill that would go to. It's 14, 15 gram material is pretty coveted material to go through any mill in today's world. So we don't see Lucky Shot as a huge mine. We think, 30, 40,000 ounce startup, and then maybe ramp it up to 50 or 60,000 ounces. So in the next, like I said, 2 to 3 years, we think we can get to that spot. And then Johnson Tract, bigger scale mining operation, similar grade. It's in the 9 gram grade, so it's similar to Manh Choh. Underground mine, not open pit, but bulk underground mining. This ore body averages 40 meters wide, so your mining costs underground are going to be pretty competitive. We're located right close to the water, so we would envision loading the ore into boxes with container lids. They can look like a sea can, but they open from the top rather than the side, and then transport them to either road or rail infrastructure where you've got a milling process nearby. So, and it's a few years behind Lucky Shot, and that we need to get the underground permitted and built, whereas we already have that done at Lucky Shot. So actually similar order of magnitude of underground workings to access the deposit to do all the drilling. It's about 1.5 kilometers of underground workings to get to the place where you're doing all the drilling at Johnson Tract, and that's pretty much what we put in place at Lucky Shot. So similar scale projects in that sense.
You're planning again. In the meantime, you're doing a lot of work on Lucky Shot, as you said. Maybe you can give me a brief overview of what exactly you're doing, but more importantly, what are you hoping to achieve? Like, what will you deem success if you look back at it at the end of the year?
Yes, actually, this year on Lucky Shot, we're on care and maintenance. We decided not to try to advance Lucky Shot until we knew we had full operations at Manh Choh, because I didn't want to commit to doing a $5 million exploration program at Lucky Shot with drilling until we knew we had the cash flow coming out of Manh Choh, because otherwise we would have run you could potentially run into the situation where you're running out of cash, which is the worst place to be, and then they'd have to turn to the equity market. So that's why we put our exploration program on hold this year. Doesn't really change the overall development timeline. We've got plenty of time next year to get the surface and the underground exploration program underway. So that's why we came to that decision. But the next level of work at Lucky Shot is to do 3,000 to 5,000 meter surface drill exploration program. We're pretty much all set up to do that. We've got the pad sites set up on top of the mountain to drill from the surface down and follow the ore body down to where we have our Lucky Shot infrastructure in place, and then the underground drilling itself at Lucky Shot. These are all short holes. The surface drilling, those holes are 300 to 400 meters deep, whereas once we're underground at Lucky Shot, you're really in the footwall of the vein. You're just drilling sort of 30 to 50 meter holes, so you're drilling a lot of them to have that tight spacing. And the reason for that is the whole mineralized vein, the vein is mineralized along the strike length and down dip. But where you want to focus your mining on is the higher grade intersections, and those are along what we call ore chutes. So they're sort of narrow troughs along the structure itself that have where the better grades are. Sort of the plus 10 gram grades are. So that requires a lot of drilling.
I would love to do a geology deep dive with you and the team on this, actually, because the Willow Creek mining district is interesting. If I've been informed correctly, it's also known for variable ground conditions resulting in complex faulting. Is there any prep work that you have to do in order to mitigate some of those risks that can stem from having that variable ground condition?
I'd actually say it's not complicated from a ground condition standpoint, because the ore is hosted in a granodiorite, which literally is tombstone rock. So it hangs together really, really well. You're absolutely right. There are faults. The vein structure itself is a series of von Echelon fault structures, and so that's why the ore body sort of comes and go, and that's what we refer to as the ore chutes. But the rest of the ore, all the development work is in really solid rock. And that's mostly what costs the money, is putting all that development work in place so that you can mine. When you're mining and you're taking out the material, the ore material, that's a relatively simple process once the development work is in place. So I'd say, as ore bodies go, the host rock is really solid. I'd like it better. I'd like Lucky Shot better if it was a higher angle. It's a 30 to 40 degree dipping ore body, which is the most expensive underground mining that you can do. So, it'll be relatively high cost mining, cut and fill type of mine, because it's relatively narrow. But the transportation will be simpler, comparing to Manh Choh, in that we have the rail just down the road from us, about 20 miles from us. We have a rail heading right there. So rail transportation is a lot cheaper than truck transportation, about 1/3 actually. So, mining will cost a bit more, transportation will cost a little bit less. And obviously we've still got to get an agreement in place as to where this is going to go, but we've got some ideas that we're pursuing on that as well, obviously.
Again, I'd love to do a geo deep dive, maybe spend like an hour or an hour and a half talking only about that. Find it fascinating. What about seasonality to exploration? As far as I'm aware, that's a thing in Alaska. Are you dealing with seasons where you can or seasons where you cannot explore?
Yeah, so exploration, if you're working on the surface, then you definitely have seasonality in Alaska, no question about that. Your season's kind of May through end of September. But once you're underground, you leave the seasonality behind. Lucky Shot as a project is really close to where 150,000 people live in what's called the Valley, the Wasilla Palmer area. So we have access to a lot of people there. We don't need a camp. You can drive up to the project, in half an hour, 40 minutes from town there. So we don't have a big camp to maintain and all that, and it's not remote. You can literally drive a minivan up to the adit. So as a project, it's relatively simple to execute and to administer, if you will. So as projects go, again, relatively simple, and it's a whole district. So I could talk for hours on the exploration upside of the district, but we want to stay focused on developing our next mine, with just doing the underground drilling. And as I said, it's fully permitted. So in terms of making that jump, once we have a mine plan, there's not any significant permitting that would need to be done to put rocks in the box and get them down to the railroad. So,
what about Johnson Tract? In that case, again, you do want to do work this year. When are we going to know more about that? And when does your season end?
Yeah. So we have a 3,000 meter drill program ongoing. We're about halfway through it. I was just out there this weekend. Things are on track time wise. We started a little late this year. We didn't get started until July, and that was obviously we just closed the transaction, so we got going pretty quickly relative to that. But we'll have a season that'll go probably into the end of September. It's a really well set up camp. It's fly in, so it's it is more complicated from an exploration standpoint. We're not set up for winter operations yet. We've got a couple of years before we need to get that upgrade done, I guess, if you will. But that will be part of the overall plan over the next 2 years, is to get that camp winterized so that when we're mining underground, we can operate year round.
Right. Okay. What about so right now specifically, when are you going to have news coming out of Johnson Tract?
Yeah, we've got we probably just will put all the drill results out at the same time. I'm going to guess October, November timeframe. We have a prep facility on site, so we take our when we drill core, we log it, photograph it, log it, and we're doing a lot of sort of extra work, if you will, because we're collecting a lot of rock quality data for geotechnical work, for starting to develop a mine plan around that, and specifically for the tunnel to get the detail drilling done. But then also we're doing a lot of environmental testing of the ore, acid base accounting, metal leaching characteristics. So all of that work has to be done in order to submit our permit application again to get the underground development work done. So we'll work on this through the end of September. Because we have this prep facility on site, we're roughly 2 weeks after we drill a hole. This hole is now logged, cataloged, and photographed, and the samples prepped on site. And so all you're sending is a little packet of powder off to the lab. Anybody who's familiar with the timeline to get samples, particularly from a remote site, it's all about sample prep, and so we've kind of taken that risk out of the equation by having our own sample prep site on site. So we were expecting to get results within a month after we send them in, which is I think pretty good time frame for today's world. And so by the end of September, if we're done drilling, by the end of October, early November, we should have all our drill results to report. Now, again, this is all infill drilling, so we're not, we're going to hit the ore body. If we don't, there's a real issue. But we're seeing the ore body pretty consistently where we plant, where we expect to see it. So I don't think there'll be any surprises. But it's a really good solid ore body. So there'll be a lot of great results. But again, I'll just caution everybody it's infill drilling. So sort of be as predicted. But again, the main thing here is to get the ore body, the upper part of the ore body that we can reach from the surface, get that drilling done. And then the next step is to get underground. And that's, like I say, we got to get the permits to do that, get the underground built. That'll take 2 years. Get the permits next year, get the underground done in 2027, and get the drilling done in 2028. So.
Are you going to be looking in the meantime to get a Kinross-like partner for these other two projects, or is this something you think you can solely do on your own?
No, we definitely need the whole model depends on sending this ore somewhere to an existing facility. So yeah, that's the other half of the work that'll be going on, is figuring out where this thing should go, where the best place to go is. And we're having meetings on that. It's early days yet, but we think these are good quality ore bodies. They're good high quality grades. And I've said this before, if you have a milling operation that's processing 5 grams, and you come to them with 10 grams material, there's a business transaction to be made there. So it's all about people making money.
What about M&A in the meantime? You planning anything, or do you have your hands full with what you have right now? You don't need additional projects.
Yeah, I'd say we don't need additional projects. We're always on the we're looking for good deals. If another opportunity like High Gold came along, we were able to acquire the Johnson Tract project for about $30 an ounce. And in our hands, with our model, as we've demonstrated with Manh Choh, we're getting $300-400 an ounce value there. So I'll take that trade every day.
Okay, so that's something you would be looking at. Is that how you pick projects to buy? So kind of based on a EV to ounces in the ground ratio, or I suppose that's not the only thing.
No. It's not that at all. Actually, it's I guess that you can take the summation of the information and calculate that. But we're looking for projects that meet our DSO model. So they have to have good grade. They have to be near infrastructure. They have to be on land that we can actually get permitted. So don't mess around with the federal lands because that's just a waste of time, in my opinion. And they have to be a high quality ore body from a permitting standpoint in terms of permitting the mine site. Because you're going to send this to a processing facility that's already permitted and been operating for years. So it's all about being above the water table, having an ore body that you can mine in terms of ground conditions and thicknesses and grades and all that kind of thing. So yeah, it's if there are 3,000 junior companies out there exploring for something, I would say about 95% of them don't make the cut.
Actually, 95% might even be good, Rick, because looking at my own track record so far, at least, which does kind of sound sad. But and to your point, the price to ounces or price to pounds in the ground ratio, they're not something I deem particularly useful. I don't think they give any real idea of what's actually going on, kind of quality over quantity type of thing here. That rings true, I suppose. But so I'm happy that you're not using that either. But looking at my clock, I also understand you have to run now. You had to go 2 minutes ago, actually. So let's catch up in a few months and see where you've gotten. Thank you again for sitting down with me. I really do appreciate it. Good luck out there, and I'll let you drop off now, as I will actually be I'll be staying in North America, but I'm going to be going to Canada, so I suppose south from here. And I'll have to be at multiple places at the same time, with that being Ontario, BC, but also in the US. I'm going to have to go to Arizona and then even into Mexico, where I'll be looking for different metals, really, but mainly gold and silver, and then maybe potentially some other stuff. You're going to see. Luckily, though, I'm not doing that trip by myself, as I'll be joined by John Mark Stouty. He's the CEO of Riverside Resources. That's a company listed as RRI on the TSX Ventures Exchange in Canada, where an average of about 41,000 shares trade each day, with a 52-week high of 17 cents and a 52-week low of 10 cents. With a market cap of about $11.5 million and roughly 75 million shares outstanding today, this is a 15-cent stock. There are no warrants whatsoever, and the 4 million options that are still outstanding make up for an almost 79 million shares outstanding. Insiders here own about 10% of the company, and over half of those shares are half of all the shares outstanding are owned by either European high net worth individuals and small resource funds, or North American small institutions, with the larger, more notable institutions on the share registry here being Adrian Day's Asset Management and Sprott Global. The last financial statement, which is dated March 31st, shows me about $7 million in current assets, $6 million of which at the time was in cash and cash equivalents. But of course, this is an active company, so that number is probably a bit lower by now, as there have been no financings in the meantime. No long-term debt was recorded either, and the current liabilities were noted at about $1.5 million, with the majority, so about $1.4 million, being a Mexican tax penalty that has not yet been enforced, but it is potentially worth a discussion later on. The rest of the current liabilities is, by the way, only about $125,000 worth of account payables and accrued liabilities, so easily covered by the cash. In terms of corporate expenses, the same financial statement shows me that Riverside spent on average about $115,000 per month, again on average over the last reported 3 months, on what I would call administrative expenses, where about half of that money, 45% to be specific, went toward management and consulting fees, director fees, and other professional fees of sorts. Investor relations represented about a third of that overall spend as well, with various other administrative expenses making up the remaining, I'll call it 20%, 25%. That's, again, only the administration spent, and the exploration and acquisition expenses actually get capitalized here, so they can be found under Note 9 in the financial statement, where I calculated an average of about $145,000 per month being spent, with over half of that exploration going, so specifically 61% being spent on geological and professional consulting, which is going to make sense in a second when I tell you what this company actually does, combined with almost 20% on top of that is transport and support, and again, various other expenses like assaying, camp, legal fees, and whatnot, making up the remaining 20 or so percent. So in summary, About $115,000 a month on average went into administration, about $145,000 into exploration and evaluation. So that's giving us about a 55 to 45 split in favor of exploration and evaluation. And of course, as always, please understand that this financial statement is nothing more than a snapshot in time. In this case, it is specifically at the end of March of this year, and it simply shows you what the finances look like on that exact date and nothing more. Finances are a fluid thing, though, and I could be making mistakes in my reading of them. So by the time you're watching this, please be responsible and go to setterplus.ca and look at all the numbers yourself to make sure you're getting the full picture. For Riverside Resources, that full picture is a little bit different than the typical company that I have on here. So I'll try and explain it very simply, but essentially Riverside is a prospect generator that's currently becoming a bit of a hybrid company that, so they have their own projects. And what they do basically is they look at these projects and then they seek JV partners or option out those projects to other companies who want to explore them, spend money on them. So that's one side of the business. And then on the other side, they're now exploring their own projects. So potentially, that's again something we can discuss later on. They become a hybrid again, an explorer / project generator, and they even own some royalties, which I'll be I'm keen on better understanding later on in the conversation as well. So that's resulted in them keeping the number of shares outstanding where it is today without having to roll it back. So it's under 75 million shares outstanding since the company's inception in 2007. So that is notable. Slide 6 of their corporate presentation does a good job of providing an overview of their business strategy and what they're involved in right now and the assets that they're currently employing or hoping to employ to continue working under that strategy. In the royalties portfolio, which, by the way, those royalties have been created and not bought, not a small and not an unimportant difference. They own 4 royalty projects, all 4 of which have gold in them. 2 are only gold. 1 is silver biased, but it has a gold credit to it. And the other one is a gold project with a copper credit to it, with Fresnillo's Tajitos project in Mexico being the star of those 4, where Riverside holds a 2% NSR. In the generative portfolio, which is what the company uses to build those royalties and those JVs and those option agreements that I told you about, there is a strong focus on Canada and specifically on Ontario, specifically on gold, where Riverside currently has 3 gold assets in the Western Abitibi Greenstone Belt, and something that we're going to talk about later on. However, as I alluded to at the beginning, they also have 2 projects in British Columbia. These relatively, I don't want to call them new, but they're relatively new. There's 6 projects in Mexico's Sonora and 1 in the Sinaloa state as well. So times are never boring for John Mark here, and hopefully we'll get to most of these assets here. But John Mark, this is your first time on the barbecue. And although you and I did meet earlier this year in Florida, I still have to kick it off with the mandatory annoying question here, if you will. But who are you and why should I trust you with my money?
I'm the founder of Riverside. I've worked in mineral exploration and mining for all of my career, starting in 1987, and lucky enough was involved in the discovery of the now called Alamos Gold, and did my PhD doctorate in mineral economics after completing my master's at Harvard University in economic geology. But that's all school. I left school and completed school and then worked in BHP and other large mining companies with Rio Tinto for a decade. And after that, we spent a couple of years in business development with Tech Resources, where we had success working in many different jurisdictions, including China and other interesting businesses. And then 17 years ago, as you mentioned, I founded Riverside in 2007. And I think the best thing is that, yeah, we only have 75 million shares out, no rollbacks, no share consolidations. We've been able to go now quite a few years without needing to finance, using self-financing from the selling of our assets. So I think track record is what you'd see and what we've done. And then that's who I am, is I'm only a director of Riverside and of our spin-out company, Capitan. I'm not involved in any other companies. I'm not in management of other companies, just focused on that. It's my largest shareholding and really enjoy being an owner of it, along with our strong European shareholder base and institutions that you mentioned. And Tony, you did a great job of the introduction. Thank you.
Thank you for saying that, John Mark. I appreciate the kind words. You know, they say price is truth. And although you have tried your best to minimize dilution and you have, dare I say, succeeded since you started the company again in 2007, if I had bought in the first week of trading, I'd still be down over 80%. I mean, I think it was at around 90 cents at a time. So what's happening there? Why is the story struggling for traction right now?
You know, it's amazing. If you would have bought on the IPO was at 50 cents. And that first day we closed at 90 cents. You would have doubled your money just on the IPO. That was 2007. It was a wonderful time before the 2008 financial crisis. So many companies actually really struggled through the 2008 and 2009. The fact that Riverside, as you said, went down. Well, we went down a lot. You didn't mention that. And then we went way up. We went up again over $1.30. At that time, it's incredible that smart people like Lucas Lundin, Rick Rule, and Kinross all financed Riverside well above $1. They saw the great potential in that nice run, and it's been a tough time. The shares that we've separated as we've done the share splits make a nice bonus for Riverside owners. Myself, having never sold a share of Riverside, never also selling a share of Capitan, really makes a combined ownership much more valuable than just looking at Riverside itself. But going right now, we are down, we're in a trading range, and I think there's an opportunity. Our enterprise value currently, if you look at our cash on hand, well over $5 million cash with no debt, as you mentioned, our financial statements, and a market cap of 10 or 11 million, gives us an enterprise value of only 6 million. So I see good upside and where we are. Price is what it is. The markets have been difficult, but Riverside, having that cash, having the royalties is in a good position. I like your questions. Thank you.
Insider ownership, as I noted in the overview, sits at about 10% now. How much of that is you personally, and what would you say your average cost of capital is?
So yeah, so it's largely myself and my family that's in that ownership. My cost is closer to 30 to 35 cents. I've participated in all financings. I've bought in the market. I've continually bought, and as I say, never sold. Even on stock options, when they come due, I pay the cash, I buy the shares, but I don't then sell them or I don't try to flip them, so I have a zero cost basis. I really appreciate it, and you know, if I could, I would take Riverside just privately myself. At this price, I would just buy the rest, but I don't think that's realistic because as I buy more, the other people would also buy, and the European shareholders, and they're not really going to want to sell out to me at this level because we are down. The markets have been difficult, and we see the intrinsic value of our multiple portfolios. Our Ontario portfolio, our Mexican portfolio, our royalty portfolio, and now our rare earth elements in gold in British Columbia. If you unlock each of those values, that each of those seems to be our enterprise value. So it would be unrealistic to think that I could buy it all for that. But if I could, I'd love to, and it would be great. It's so incredible. My house in Vancouver is worth half of the enterprise value of the corporation. It's a real joke. The cost of housing versus the value of owning royalties and assets. Riverside's a really good ownership situation.
I think that actually paints two pictures where the housing market in Canada is just completely out of hand. And the capital markets in Canada are completely out of hand as well. But unfortunately, to the downside, is Riverside Resources a significant investment for you though? Do you have, I mean, much else in your portfolio outside of your home there in Vancouver?
You know, I've done well in my investments and I worked in different things. And so I'm quite comfortable and solid. And so I'm not under stress. I'm able to participate in all financings. I'm not feeling like I have to sell anything. For me, it's my passion, it's our love, and I'm committed to doing it. As I say, I'm not in doing anything else. And anyone that works in Riverside or works around me never has a doubt that we're working in Riverside and we wear the Riverside hat and have passion about it. So yeah, no, it's a really great place to work. We're a family environment. This morning I was up at 3:50 making coffee for my couple of my staff and taking them to the airport so they can make their 6 a.m. plane. That's just the passion we have.
I'm glad you're mentioning the Riverside hat, and I should have put it on my desk because you gave me one in Florida. I'll take a picture. I'll put it on the screen so people can see it. That's a great hat. Do you personally own any royalties or anything like that on the projects, or you or your family? Is there something else like a service business or a consultancy or a helicopter agency, something that is less than an arm's length away from the company that currently services?
Not related to Riverside, no.
Okay, good. I do see that
I really think it's important. Yeah, Riverside management in no cases or any people have any special agreements where they get royalties, and I frown upon that. I don't think that's fair for shareholders.
Yep.
And I'm a stand for being a shareholder and making the very best share investment.
100%. That is the reason why it's part of my my fixed annoying questions, if you will. Some people don't appreciate being asked that. I'm glad you do.
No,
I
take on anyone about it.
I do see that you use stock options though to incentivize management, that which of course is important. Based on your last MD&A, you granted 1.7 million of them to directors, management, and consultants at 12 cents per share. But again, the stock price hasn't really done all that much. It's in that range that you told me about. So how do you measure performance? Like, what is success? Because this is a performance bonus, but what is success to
Three
you?
things. First is getting partner funding. So for us, Fortuna Silver is huge. We have done really well in getting Fortuna Silver. Second is strategic alliances. Riverside has been amazing in being able to get strategic alliances and be able to get strategic alliances like working with BHP, the world's largest mining company, that they're fully funding our team. So our staff and our team and everything doesn't cost shareholders much. You were going through the financial statements, and one of the magical things about our financial statements is the income that we're getting that's covering our costs. So we're paying all of those, but we're getting income. You look at our financial statements and we magically can spend 150 or $200,000 a month, and yet we only burn through $1 million a year. The math doesn't add up. Only it adds up if you look at the income part, the income that we get, because we're billing our partners, we're billing the work we're doing. So we give a bonus to those people and to that team that can actually generate that, because I think for shareholders, that's amazing. You're giving the shareholders the upside and you're not actually costing them the cost of the staff. So that's terrific. Options only go to people that are working full-time, that are consultants with the team. We don't do marketing options. We don't do options and things. We don't do share swaps. We don't do anything in that way. We specifically, we pay for our fees. We don't give away shares. People that are working in the company, we try to incentivize them because we want them to think and act as shareholders. And we do. People don't travel business class. I drive instead of Uber in the morning. I make coffee at my home and give it to the people rather than stopping at Starbucks. Those simple things are part of the ethic of Riverside.
How much are you expecting this year in terms of income?
We'll have spending of partners of over $2.3 million total spend, and we get a 10% fee from that. Plus, more importantly, we bill over 2/3 of our time and work to those projects that we do. So it really cuts to only 1/3 of the embedded cost of what would it cost to have staff. So that's really good. So it doesn't look as income, but it's actually displacing what would otherwise be cost to carry the staff, the equipment. We buy the trucks, we buy the different equipment and charge it to the projects.
And as I mentioned,
other people's money.
OPM. As I mentioned there at the beginning, the biggest spend there for you was geological consulting, because that's what you do. You analyze these projects. And so I suppose that's what you plan on doing, or is it not? Do you plan to drill any of the properties this year yourself, or are we going to see some drilling spend on the financial statements? How do you look at that?
Recently, we drilled at the Oaks project, and that was excellent. Now we've bundled that into the subsidiary called Blue Jay. We could drill again on the Pichette project. We think Blue Jay will do that, but probably financed from additional capital coming in. We have the capital, we could do that. Secondly, we have drilling going with Fortuna Silver. They're drilling at the Cecilia project, and that's good. I think in the near term, you may see additional transactions signed, possibly for the Union and REL. We have drill permits on both of those. Riverside could drill potentially at Union. If we have a partner to fund drilling it, that's better. We are glad to drill, but if we can have a partner spending, that would be great. So we always try to find good partners to do the drilling and take it. They can raise money to drill. We're glad to own the assets. We have found that the markets go up and down quite a bit with these choppy markets. Often people under an option agreement don't complete the option earn-in, and the project reverts to us.
So far, since I've been paying attention or closer attention to the space, the only thing that the market seems to care about is high-grade discovery holes over many meters, irrespective of the commodity, gold, copper, silver, whatever, uranium, high-grade, a lot of meters moves the market. That's kind of my 70 IQ thinking of things. And with you, we haven't really seen a major discovery from those efforts. And I understand that's not your main line of business, as you just explained, but is that something you're going to be aspiring for? And do you think that you still have the potential for a large or high grade discovery in the portfolio?
So I think we've actually done fairly well. Capitan silver is now going, and the silver values are there. Some of the silver values are over a kilogram silver, so very rich. We were lucky enough to drill out a large heap leach gold body, and we are able to dividend that to shareholders and keep a royalty. I think that project would be in production. However, the Mexican government and Mexican policies over the last 6 years have not really supported that approach. I'm very excited by the royalty we have, particularly because our royalties are just general NSR royalties, not tied to a specific metal. They're not just for gold or just for silver, but for all the metals, anything that's produced on site. So the high grade silver, you know, the Peñoles company has been going for over 160 years, started in the Peñoles village that we own the vein. So the vein, the Cruz de Plata, the project we're doing is where that corporation even got started. It's a very good, rich district, kind of like Hemlo, known for high grades. In Tajitos is another very good project that we have. And they're high grades up to half an ounce, even up to an ounce gold, underground mining, underground operations. And we own that underground operation, and we've sold that to Fresnillo. It's part of a larger open pit. Typically, you find high-grade feeder structures, and that feeder structure could be mined underground. It has been mined underground, and that would be very rich. Generally, people want large numbers of ounces. As we go to large number of ounces, then you transition from a spectacular high-grade hit into something that's very large. You go to lower grade, larger tonnage to make large mines. The Tajitos has also been very good. Even at Sugarloaf Peak, there's actually a small high-grade mine in the middle of our larger resource. That older small mine is high-grade and structurally controlled, and there's gold mineralization. So I think your question's good, that people like to see high-grade, and these projects have had high-grade, and we've been seeing these projects move ahead. Arizona Metals was a good spin out for us. We were able to take that project and put it into Arizona Metals, the Sugarloaf Peak project, retain a royalty, and made over $7 million out of the selling of the shares that we were granted from that transaction. And so Riverside's not had to go back to shareholders, and we've given our shareholders chances at shots for discovery. And now I'm really excited by the drilling that we're having with Fortuna. It's a 2,500 meter program, drilling 3 different targets, and each of those could be company maker scale targets.
I recently interviewed Alberto Roscoe from Capitan Silver. For people listening, they can go and watch that interview. It was a pretty in-depth interview. This is also a Michael Gentile company. That's where the connection for me comes from. And I did meet Duncan from Arizona, but I haven't interviewed him yet, and I should bring a change into that. What I'm really asking here, though, John Mark, is yes, those discoveries were previously in your portfolio, but then you spun them out. Do you still see more value in doing that, or do you think there is value in, again, drilling them yourself and keeping them on your own balance sheet just within Riverside?
No, I think it's excellent, great for shareholders. Shareholders get them, and if we can do that again with Blue Jay, being a shareholder, that's amazing. You get these spin out dividends, as you saw with Golden Valley, as you saw with Almaden and Almadex. Giving the shares out to shareholders is really good, or even Altius, and doing Altius royalties out of Altius and things like that is a great way to pass it out. So for us as owners of the company, shareholders, it's great. We don't need a bigger company. We're glad to get these benefits of being a shareholder, which is pretty cool. And then we can either hold them, liquidate, what we wish to do, but it's good. If we dilute the shares of Riverside by pursuing one of our assets, which we could do, it dilutes the ownership in all the other assets. If we divide it up into specific assets and go ahead and do them as a specific project, the larger central part doesn't get diluted. So Riverside only has 75 million shares out, yet we've been able to do 84 projects over 17 years. And of those, we've had a number of discoveries, we've had a number of different things. We've helped form 7 corporations, and we've not had to go back and restructure the company. If we actually go forward and do the drilling, especially at 15 cents, at 15 cents for every $1 million we raise, that's 7 million shares of dilution. That's a lot of dilution. And if you look at our drill program, we're spending right now, we got another $1 million from Fortuna Silver just last week that they're giving to us. That saved our dilution of 7 million shares to shareholders.
Dilution risk is one of the major things in our space.
Not
right?
with Riverside, exactly.
And so that is something I'm happy you're cognizant of that. And this goes back to, I suppose this is the forever discussion, right? Do you do equity dilution or do you do asset level dilution? And maybe we have to, this is where we can talk about the other 2 parts of the business where the prospect generator is more important. Then we'll talk about Mexico and your royalties and some other stuff later on as well. So I'm not going to ignore everything that you just said. But so the prospect generator side, since you started the company again in 2007, there has been a surge in the number of companies that operate within the same or comparable business model, at least to, I don't have the hard data, so I might be making stuff up, but that's how it feels to me. So essentially creating more competition for you to get deals. But it also seems to me, again, I might be wrong, so correct me if I am, but it seems to me like the majors have less and less appetite for early stage projects, and they want to be buying kind of PA, PFS, DFS level, or even more advanced than that, even projects. So how are you finding the demand for your business model in the current market environment?
So I don't think it's actually changed. Having been in the industry now for 35 years, honestly, everyone always wants a feasibility study, wants a mine permitted, wants something to be built. And I find, honestly, the majors have looked through everything and they want fresh material, fresh projects. And therefore, they have funded us over the last 17 years with these strategic alliances. They fund us to do the work. And we've been able to get 4 times every dollar we have spent with partner funding, spending 4 times more to do the exploration and do the work. What they need are ideas. What they need is a capacity of a team that can do it safely and can fit within their ESG protocols. Yeah, everyone would love to have a permitted, developed project, and yet there won't be of the quality at the scale or the type that they need. And if they do, then it would be highly valued and people would develop it without them. So I think that actually it's a good business model. It's proven to be a very important business model. And it's really around jurisdictions, I think. Which jurisdictions allow the projects to move ahead and where people can get drilling quickly and move projects ahead rapidly. We've been able to get drill permits in Mexico. We've been able to get drill permits in the United States, and we can get the title and move ahead rapidly in Canada. And those are things that you need to be able to do to really operate the model.
Some of your projects in Ontario are closer to those larger companies that we talked about, like Equinox, right? And most of them have, like the stuff in Ontario, that's always curious to me. That's another question I always like asking is, but a lot of the stuff in Canada has already been looked at historically. So how do you avoid becoming just another junior staking claims in someone's shadow?
Yeah, I think generally it used to take at least 7 owners and at least 25 years for a prospect from finding something to turn it into a mine. I think anything it's taken more time and more owners. It's difficult to stay into a project. Thus, Riverside tries to get a royalty and retain a royalty. If we can have a royalty on the project, we get a free carried along, and we don't try to actually do with the heavy lifting. We try to have cash when we need to. In other words, if the project all of a sudden comes back to us, or if a corporation can't do it, then we've got the whereabouts of having a strong balance sheet to support, to take that project, nurture it along that level until it can go back to someone else that can spend to drive it ahead. Projects are incrementally going ahead and you're killing them. They don't not going to all work. It's going to be a very long, very rare number that make it through. So you need to turn them over. So you're right. Projects have been looked at, and it takes a discovery that's over a very small area. And also usually discoveries go from something shallow on deeper. So we just are tickling things down to less than 100 meters ourselves, actually, and leave it wide open at depth. The discoveries like a Cisco and other groups that are drilling down hundreds of meters, even kilometers deep, and chasing them down, finding them into giant deposits like Eleanor, even where Virginia gold mines made their first discovery and then were able to progress it and then eventually sell it. And so I think that's a proven model. There's a lot of new cover, a lot of new areas to go out and explore. And with agriculture, and particularly with the clearing of the fields and clearing of the areas for the timber and logging, we find new outcrops all the time that the logging trucks have uncovered. It's really amazing what you can find with just the logging. And now with the forest fires, it's made a huge difference as well. The forest fires have burned, unfortunately, large areas, exposing areas that never really were seen in the last 100 years. So Canada's wide open for that.
Has that, what you're telling me here, has that changed the deal structure for JVs? Has that evolved? Like, what are JV partners asking you for these days? And is that different than what they were asking you for in 2007?
I think there's a bigger priority in having mineral title now and clarity of title. I think there's also a real big priority on is the project permitted for drilling, or can you get a drill permit? So we spend a lot of our effort. You look at our financial statements, we have a lot of consulting costs around getting permits and making sure that we've got everything lined up around mineral title. So it's a very much of a turnkey solution. I think the second thing is Riverside brings an operating team. I think in the past, people would bring projects and the corporations would have an operating team. Corporations have downsized their operating capacity and their bureaucracy and the number of people they have. So Riverside has continued to provide that as a turnkey solution. I think that's a real value add for what we bring, not just a project, but knowing the project and a staff that can operate the project and has the relationship with the community and with the surface owners in order to develop the project. Major companies can really bungle that aspect. It's difficult to kind of be able to work with the different local people.
It's good that you're bringing that, because that's also something I wanted to ask you about. Is you're bringing that operational team, and when it comes down to gold and silver and copper, you've again proven that you can spin these things out. You're making it work, no dilution, all these things that you told me so far. But why REEs? Why rare earth elements now? And maybe more importantly, do you have the technical expertise on staff to deal with REE projects, given you've historically, again, mostly dealt with precious metals and copper?
Yeah, so we're doing mineral exploration. We're not doing processing. We're not doing mining. We're not building. What we're doing is identifying and delineating and having the resources. I think the world is going to be under siege and is relative to China, and particularly rare earth elements. Rare earth elements are vital for your phones and for electronics, for our computers and for our cars. And if we go into difficult situations, we do not have alternative sources. Canada, the United States will need to have those. And I think it's a great opportunity and so important for us. It's our duty as mineral explorers to build up those key resources that we need to have. In World War II, there was so much a focus on tin and tungsten and lead that was needed for bullets. And there was all this big study and look and hunt for those. So I hope there's not another world war. I hope we're not going in that direction. But I do realize we need to have our own sources for rare earth elements. The skills you need to find them is geochemistry and geology and fieldwork geophysics. It's not anything specific to the element. It's really more about the processes of mineral exploration. We do the same work, we do the same assays, the same type of exploration, independent of the commodity. And so, yes, we have the skills to do it, and we work in that way. And we have proven we have the skills to do that. We've been hired by more than a dozen companies to operate and do that, where they've paid us 10% over all of our costs just to do it for them.
What about the demand in that case? Again, we talked about demand for JV projects earlier as a whole, but are there enough potential JV partners for REE projects these days in Canada, given China's dominance of the market, as you pointed out?
Yeah, I think actually there's a need for a quality assets of rare earth elements, and I think it needs to be in places that you can get to. So geographically, Riverside is trying to work in regions that we can drive to, not do helicopter, not remote, but where there's infrastructure. Canada is blessed with a large country, but not with a lot of infrastructure. And much of the work in many of the metals, including in rare earth elements, is in remote locations. I think we're going to need them in very practical locations that can be gotten to. And I don't think it'll be JV partners. I think it's actually going to be the government really wishing to see these developed, government grants, government support in developing them. I think Riverside, as we've shown, could very well develop the rare earth elements to a level which could then be its own corporation, and the corporation could move ahead. So we're the nest nurturing through the rare earth elements. And once we found sufficient to do financing about them, it could make its next corporation out of Riverside. So I'm not worried about that at all. I think that's something that Rick Rule has commented, is how we basically have really worked on being a bit of a merchant bank and helping to create not just projects, but also new corporations around quality projects. So I thank you for your question.
So, well, ultimately, you want to get money from the government alongside what you already are funding without doing dilution, and spin out a different, so a rare earth elements Explorco on its own, like you've done with Capitan and all the other companies.
That's correct. That would be one scenario. It's a very workable scenario, and it's a path we can follow at this time. So we're not taking skills we don't have and not having to spend too much money to be able to use government data and government work and put it together. And I feel and we've actually been lucky enough to win some different grants already.
That'd be a very interesting development to watch. I don't want to waste too much of your time. I want to be respectful for your time, John, Mark, and I want to talk about Mexico. And Mexico, you say, is part of the valuation of the company. What you actually say is it backstops the valuation of the company, specifically with your royalty on Fresnillo's Tajitos project, which is, again, Mexico has just introduced a ban on open pit mining, though. So talk to me about that. How dependent are you on the political situation in Mexico?
So I really hope your listeners will listen. That ban is not on open pit mining. It's on new titles. So on a new title, we're not talking about anything here is these are existing titles. The Constitution is being proposed, and it's not been passed yet, but it's being proposed that on new titles, they would, on a new title, not allow open pit mining on a new title. These are existing titles. These are existing projects. These are existing resources. If the government did actually try to ban something that was on an existing title, then that would go against NAFTA. It would go against the financial ability, and the corporations could actually go against the government of Mexico asking for reimbursement for all the money they spent. So that's not happening. The government is not canceling. The government is not saying no to existing titles. It's for new titles. It's really helpful that you have this chance to explain that. And I know it's a really interesting situation that the headlines haven't quite gotten that detail, but I think in a lot of things in headlines, they don't get all the detail. And it's a helpful detail to get that it's not on existing title properties.
So, because when I looked at the situation with you and BHP, I thought, oh, is the jurisdiction part of the reason why BHP is walking away from this partnership? But you don't think that is?
I think it is. I think that BHP really got screwed on petroleum. BHP is a giant petroleum company, and BHP Petroleum spent $2,000 million. That's $2 billion. They spent $2 billion doing exploration on their Typhoon project in the Gulf of Mexico. And then the Mexican government changed some of the conditions and made it difficult. And basically, BHP felt like they had to give up that project and return it. So the minerals project and what we did was actually collateral damage, was minor and didn't matter at all. What we were looking at is much larger, around major corporations dealing with big political issues, and we were just a little casualty along the way. So yeah, I think it was related to some of the situations and challenges. It did not relate to the open pit. It did not relate to the current thing that was actually in the past. I think one of the key steps is getting mineral title, because in fact, There are no new mineral titles. So that's the joke. The joke is they're not banning anything. They haven't even given very few mineral titles in the last 10 years. So if there have been no mineral titles, say in the last 5 years, and they're not planning on giving mineral titles, then this whole thing is actually a bit of a farce, because it sells great newspapers. It becomes very politically interesting, but it has no meaning because there are no new titles to even ban mining about.
Does that mean that it doesn't lengthen your path to cash flow from those royalties at all?
So the speed at which Fresnillo chooses to go ahead and put the mine into production, and it could put the mine in production, as an underground mine as well, because they're the high grades, or it could do it as an open pit, but it's up to Fresnillo on their term. The other projects, for example, Capitan is going for the high grade silver. It's a very good silver zone that we're hitting, that's there at the project, at the Cruz de Plata project, and we're delighted to have a 1% NSR on that. So yeah, it really is up to the corporations that are working there, and it's access to capital. So access to capital, it's difficult to get capital to come to Mexico, but the projects are very good. The projects are really better technically than projects outside of Mexico. So they're very good projects. Mexico has been a world leader for silver production, for example, for 500 years, for 5 centuries. So, we're looking at things that have gone for centuries and almost half a millennium. And then we're talking about politics of what's happening this month or this year, and it's different scales. And so the projects are very good. We know they'll last a long time and do operationalness. And we'll see now with the new president what really transpires at once she's able to take power in early October.
How important is the royalty business as a whole to you, though? I mean, I see that most of the royalties you do have buyback provisions on them. So how important are they to you as a company, not only the valuation, but to the operations of your business?
Yeah, I like the buybacks are fine in that they have, like on the Fresnillo royalty, has a deadline. So it has a deadline. The deadline will be in 2026. I think royalties are very important to us, and it's difficult to get royalties as people don't want to give them, especially when we're generating them. We're not buying them. So we're generating, in other words, people are giving them to us, but we're not having to pay for them. If we had to pay for them, then it would be a different story, because people would be getting money for giving us a royalty. But no, they're simply, they're getting the project and we're getting a royalty, plus them paying us to take it over is a great deal for us. So for us, the royalties are very important, but they're not the only thing. We like the discovery potential. We really like the dividends, and we really like owning the percentage in the projects as well. So we have multiple different prongs. We never put all of our eggs in one basket. And that's one of the ways Riverside's been able to survive for 17 years, not being bet on just one thing, and always been keeping royalties where we could. And you're right, some of the royalties have different terms. It really is what we can negotiate. And I don't know many people that have a royalty with Fresnillo. When Fresnillo, we know they're going to build a mine. They build mines. They're the world's largest silver producer on the planet. And they're a very large gold producer. And these aren't small companies. These are big mines and big operators. So we really see the potential there to be quite significant.
It just reminded me that 2007 was 17 years ago, and I got a little sad about that. In my mind, it's like maybe 7 years ago, not 17. But what I'm getting out of you here, John Mark, is that you can sustain operations and do everything you've told me today that you want to do without having to go for a capital raise anytime soon. But it's still an option to you. So how do you view capital raises? Like, is that a tool you're ever going to use again, or like, how do you see it?
Oh yeah, so we use it, and I like to go to owners and go to the fellow shareholders. We usually non-brokered and usually go to the owners, and I write a check as well. Glad to own more of the Riverside and do it, and for strategic reasons or for things that we need, and we can do it. Now the fact is, the royalty portfolio, we have that could potentially be sold or transacted, or Riverside could have some transaction around it, and that has great intrinsic value, probably more than just our enterprise value, just that in our royalties alone. So there's access, or we could sell one of the royalties or something. So we have a lot of different options, not simply having to do share issuance. I think there's other ways to get capital, as we've done. We've sold projects and gotten capital. And you mentioned about selling project interest. Well, I'm glad to sell a project interest, and therefore I don't affect the overall entireness of the whole corporation. And so I think different projects can be sold or have different business terms to them. And on Fresnillo, if Fresnillo does buy out the royalty, that would be another $3 million into our treasury to us. Yeah, the royalty goes away. We'd prefer to keep the royalty. We see the royalty has great upside value, particularly because we have 40 square kilometers of brownfields around the Tajitos. And each of the orogenic gold systems have grown at least 3 times and sometimes over 9 times larger than the original resource once they started to mine and grow. So they've all grown at least 3 times bigger. So a resource of already 1.3 or 1.5 million ounces becomes 4.5 or 5 million ounces of gold at Tajitos, if you look at that type of range in the overall district belt, and we can see potential. So for us to have a 2% royalty on all that brownfields land would be wonderful. But if we get more income, another 3 million US into the treasury, we don't have to come back and do an equity financing.
I'm about to let you go here, John Marcus. I know you're busy. Just one last thing. What are you doing in Ontario this year? I think that's kind of the star of the show now, or that's where the most potential upside is. At least that's how I see it. Is that how you see it? And what exactly are you doing to get
we're
that?
super excited by the Pichette project, and we working on another transaction around that as well to kind of further consolidate and expand the property, which we like. We love the high grade. You mentioned high grade. We have ounce per ton gold on the surface. We have drilling of 0.5 ounce in historic drill holes, and we're doing surface work. We're doing stripping. We're doing bulldozer work, mapping and sampling on that, teeing it up for a drill program. We're not drilling right now, but it's now into a corporation called Blue Jay. Riverside has a 2% royalty on each of the projects of Blue Jay. So Blue Jay is doing that work as Riverside's funding it, and that's good. So we see exploration, sampling, geochemistry, some geophysics. We're actually flying a LiDAR survey as well, which is pretty cool. Got a bunch of stuff going. We're really excited about teeing up Blue Jay for a really great 2025 and onward. It's going well.
So you have your hands full, and you have to keep telling the story as well. I suppose that's part of the reason why you're here today. But what else are you doing? What conferences? Do you go to road shows? How do you get the larger companies interested? What's your general approach to marketing?
Well, I'm so lucky to work with Eric. He's awesome. He and Darren are fabulous. The thing they really do is they're professional. We're working on the deck. We're working on the information about Riverside. Please come to our website. We welcome interacting with people. We're available on the phone, available for videos. We do some conferences. We did the Rule Conference. I'll be heading off to Beaver Creek in Colorado to meet with investors and particularly with other corporations. I'm actually an invited speaker, a keynote speaker in Mexico at the conference in October, as well as going over to Europe in October, November to meet with shareholders. We do have 40% of our shareholders in Europe. Later in November, more conferences with investors. So we do that. Also the website and particularly digital marketing. So we spend, as you said 1/3 of our cost overall, 1/7 of our global annual budget is spent on marketing overall. So we've always tried to make sure we have some marketing presence to whatever we're spending. We think it's important for the value of shareholders to be able to see liquidity and to keep up with what's happening with the company of Riverside.
Well, what do you think that's going to equate to? That would you say 1/7 of
about 300,000 Canadian dollars a year is our general budget for investor relations that we spend each year.
Okay, and that is out of the total budget, so that includes your exploration and evaluation expenses.
Total budget's about $2 million total budget that we spend each year, and we make back about $1 million a year in fees and share payments and other payments to us in what we do. This year we'll have over 2.6 million of partner spending, at least, probably more than that, depending on what happens now with this drilling we're doing. And I just was informed yesterday, we're getting more money from one of our partners. They want to do more work. They like the results we've gone so far. And so we'll even have a higher budget remaining in this year. You know, you get to the end of the year, and if you have a team that's operating and a team that's set up, you have unused capital in companies. I found that it sometimes can often come and be spent on our projects. And so we've had, I'd say more than 30–40% of the years, we've had additional budgets added to us in September to the end of the year as people realize the results we're having are positive and we can deploy the money in a way that will add value for the partners.
Well, that's it. I hope I can keep following along throughout the year and keep having conversations with you. Thank you so much for sitting down with me today, John Mark. I've tried being as annoying as possible. What am I not being annoying about, though? What am I forgetting to ask you here that I should be asking?
Oh, I don't find this at all annoying. I mean, I love it. And I really liked you asked about people that have royalties and other things or any type of Klingon things, because we don't, you know. That's why I founded the company with the very first share, because I wanted to make sure there were no skeletons in the closet. I wanted to be very honest. And you're like, why am I so friendly? Because I'm just having fun. Look, this is just great. You know, I've got a great team, very lucky. Love the people we work with, and I think people enjoy working here, and we have a lot of fun and we have great projects. And when you're so undervalued, it's really cool because you know there's intrinsic value and you don't worry about it because you're like, I own something that's really good and we have the cash in the bank. So with cash in the bank, you're in a good situation. And you know, a lot of companies are doing $500,000 and less of financings. And just when you look at the fees and things like that, and then they maybe have to put a warrant. The fact that we have no warrants as well is amazing. So the only way you can participate is by owning shares. So it's really good. And I think you've done a good job of looking who owns the shares. It's surprising more people don't buy in the market, but those that do buy in the market are sure to be rewarded here with the results of what we can do at Blue Jay, what we can do on the other projects, and the fact that we have Fortuna coming to drill right now, and you don't have the risk of a financing being pulled on you. It's a great time to own Riverside right now, buying shares.
That's John Mark Stouty of Riverside Resources, RRE, and the Ventures Exchange. Sir, thank you so much for investing your time with me today.
Thank you. Really great, Antonio.